Thank you. I declare open this hearing of the House of Representatives Standing Committee on Economics for the review of the Reserve Bank of Australia Annual Report 2024. I extend a welcome to representatives of the Reserve Bank, my fellow committee members, as well as members of the public and the media that will be watching the telecast. These hearings perform a critical transparency function, helping shed light and better understand the shaping of monetary policy with current and likely economic conditions. Today is also important as it's the first time the committee has the opportunity to meet with the RBA since the reforms to its structure. Over the last few years, our economy has been confronted with a range of challenges, domestic and global, from post-COVID-driven supply-side constraints fueling inflation and monetary policy responses through to global energy shocks. As a nation, there's been a focus on easing the burden of cost of living pressures on families and individuals. Combined with the efforts of the Australian Government, the Reserve Bank's decision to reduce interest rates last month will add to that relief, following earlier cuts in both February and May. In the face of all this, it's extremely heartening to see that over the course of the last financial year, Australia has been able to achieve something many other major advanced economies haven't been able to: maintain continuous economic growth, keep unemployment with a 4 in front of it, see inflation fall from 7.8% in 2022 to now 2.1% on the most reliable measure. It comes at a time where there have been concerns about the impact of global trade instability and the implication of tariff movements on the decisions of advanced economy central banks. In accordance with the committee's resolutions of 31 July 2025, the hearing will be broadcast on the Parliament's website, and the proof and official transcript of the proceedings will be published on the website. With obvious great public interest in the proceedings, it's important to emphasise to everyone present that these are parliamentary proceedings which must be conducted with decorum and respect. Those present here today are advised that filming and recording by the media is permitted during the hearing. However, we ask that members of the media present or listening report the committee's proceedings fairly and accurately. Media present are also asked to conduct themselves in a way that doesn't interfere with proceedings and should not encroach on the committee's work area or film or photograph documents or devices of committee members, witnesses or others. And with all that, I now welcome representatives of the Reserve Bank of Australia, thanking them for appearing at today's hearing. Before we formally begin, for the Hansard record, I was just wondering if you could please state your full names and the capacity in which you appear before the committee, beginning with the Governor.
Thank you. Michelle Bullock, Governor, Reserve Bank of Australia.
Sarah Hunter, Assistant Governor Economic from the Reserve Bank of Australia.
Christopher Kent, Assistant Governor Financial Markets, Reserve Bank of Australia.
Bradley Jones, Assistant Governor Financial System, RBA.
Tremendous. Thank you. I must remind you that although the committee doesn't require you to give evidence under oath, the hearing is a legal proceeding of the Parliament and therefore has the same standing and warrants the same respect as proceedings of the House. The evidence today will be recorded by Hansard and attracts parliamentary privilege. The giving of false or misleading information or evidence is a serious matter and may be regarded as a contempt of Parliament. With all that warmth, Governor Bullock, can I welcome you formally and invite you to deliver an opening statement, please?
Thank you very much, Chair, and good morning to the members of the committee, particularly the new members of the committee. These hearings are a very important part of the accountability process of the Reserve Bank, which the Chair has already pointed out, and my colleagues and I are very pleased to be here to answer your questions today. So, as I said, I'm really pleased to see the new members of the committee. As you would be aware, some of you will be aware, others may be not so aware, the RBA's mission is to promote the economic prosperity and the welfare of the people of Australia now and into the future. We do this by conducting monetary policy with the aim of maintaining low and stable inflation and full employment. And we also support the stability of the financial system. But our responsibilities go a long way beyond this. We also work to support a reliable, efficient and competitive payment system. We deliver efficient and effective banking services to the Australian government agencies, and we also provide secure and reliable banknotes for people who want to use them. So there have been some very important changes at the RBA since we appeared before the previous incarnation of this committee in February. From 1 March, the amended Reserve Bank Act 1959 came into force, creating a new Monetary Policy Board and a separate governance board. And since we last met with the committee, the Monetary Policy Board has lowered the cash rate target, which is our key monetary policy tool, by a further 50 basis points to 3.6%. That was following a 25 basis point cut decided by the previous board in February. So I'm going to start with some background to these monetary policy decisions and the outlook for the Australian economy. Then I'm going to make some remarks on the payment system and banknote distribution, and then I'm going to finish off with an update on our progress towards achieving the objectives of the RBA review. So as I noted, the Monetary Policy Board conducts monetary policy with the aim of maintaining low and stable inflation and full employment. The statement on the conduct of monetary policy, which was updated in July, sets out our agreement with the government that an appropriate goal is consumer price inflation of between 2 and 3%. To achieve this, we set policy such that inflation is expected to return to the midpoint of the 2 to 3% target range, so 2.5%. But there is flexibility around the time frame in which we meet our inflation objective, and this is to balance this with meeting our full employment objective. Achieving the maximum level of employment that's consistent with low and stable inflation in the medium term. Consistent with this, the board's strategy to achieve our dual mandate over the past 3 years or so has to bring inflation sustainably back to target within a reasonable time frame, while allowing the labour market to adjust gradually towards full employment. On the first part of our mandate, inflation has fallen substantially since the peak of 7.8% at the end of 2022, and it's now within the 2 to 3% target range. The higher interest rates over that period have helped to put downward pressure on inflation and to keep inflation expectations anchored. Underlying inflation, which we focus on trim mean in particular, that removes the more volatile components of the index, and that fell to 2.7% over the year to June 2025. Headline inflation, which has been affected by temporary cost of living relief measures, was 2.1% over the year. On the second part of our mandate, labour market conditions are close to full employment. The unemployment rate of 4.2% in August remains low by historical standards, with the share of the population with a job is close to a record high, and this is really good news. While labour market conditions have eased a little since we last met, with the unemployment rate rising a little, we assess that some tightness remains, although there's always considerable uncertainty around this assessment. Throughout this adjustment to towards full employment, the economy has continued to expand, and growth in economic activity has also picked up since we last met, driven by the recovery in private demand. In terms of jobs, there are 1.1 million more Australians in employment than in mid-2022. This is clearly a welcome development for those individuals, their families and the wider Australian economy. Over the period since we last met with the committee, the board judged that it was appropriate to ease monetary policy to keep inflation close to target and the labour market at full employment. As I mentioned, we've lowered the cash rate by a total of 75 basis points since the start of the year to now be 3.6%, after being held steady for a time at 4.35% since November 2023. RBA forecasts from the August statement on monetary policy suggested that underlying inflation will moderate a little further to around the midpoint of the 2 to 3% range. These forecasts were conditioned on the market-implied cash rate path at that time, which included some further modest easing of monetary policy. The recent interest rate cuts are expected to support spending by households and businesses, and growth in the Australian economy is expected to pick up a little further over the next year. The recovery in household consumption growth is forecast to be sustained as real incomes continue to grow. Since the August meeting, domestic data have been broadly in line with our expectations, or if anything, slightly stronger, and the board will discuss this and other developments at our meeting next week. But forecasts are just that, they're forecasts, and the economic outlook continues to be clouded by uncertainty. And this is especially so the further into the future we look. So we need to be alert to the risk that circumstances may change and be prepared to respond if necessary. The global environment is particularly uncertain and unpredictable, but monetary policy is well placed to respond if it seems international developments could have a material impact on the Australian economy. There's also a risk that the recent pickup in growth in domestic economic activity is not sustained, but on the other hand, it could be materially stronger than we anticipate. And finally, there may be more excess demand in the economy and labour market outcomes may be stronger than expected. We're mindful that productivity growth has not picked up and growth in unit labour costs remains high. So the board will remain attentive to the data and the evolving assessment of risks to guide its decisions. We've made real progress in bringing inflation down, but our job is to make sure it stays within its target range in a way that's sustainable, not just for now, but for the long term. Low and stable inflation is important because it means that households and businesses can plan, can invest and create jobs without having to worry about inflation. Before I move on to other parts of the RBA's work, I want to acknowledge what many Australians have been through over the past few years. We know that high inflation has pushed prices up across the board over the past few years. As my colleague Sarah Hunter explained in a fireside chat last week, while inflation has fallen materially, the price level is not coming back down. The higher price level has affected everyone, whether you're paying a mortgage, renting, running a business, or just trying to make ends meet. And it's been especially tough on people with lower incomes and those in more vulnerable situations. So this is why, as I've said, it's so important that inflation remains low and stable. Now, another critical area of work for the RBA is our regulation and oversight of the payment system. We are currently conducting a review of surcharging and merchant payment costs. We've published a consultation paper in July which outlined the Payment System Board's preliminary views on this. The current framework has effectively been in place for 25 years and it's served its original aims. But recent and likely futures in the payment system means that it's less fit for the future. We've received over 170 submissions in response to the consultation. We value this strong engagement and we're now following up with stakeholders to discuss submissions in further detail. It's fair to say that different stakeholders come at the issue from very different perspectives, and we've seen this reflected in a wide range of views. The task now for our Payment System Board is to carefully consider all this feedback so that we arrive at policy settings that best promote competition, efficiency and safety in the card payment system. We also thank the Parliament for recently passing amendments to the Payment Systems Regulation Act. These amendments will modernise Australia's payments regulatory framework so that a broader range of participants in the payment system, such as three-party schemes, mobile wallets and the buy now, pay later providers, they'll now be included in our regulatory oversight. We'll consult soon to identify some priority areas that should be addressed under the expanded remit. We want to ensure that Australia's payment system remains world-class well into the future. Now, another issue I'd like to update the committee on is recent developments in the cash distribution system. Cash remains a critical part of a resilient and inclusive payment system for all Australians. Although the use of cash for everyday payments has declined in recent decades, 1.5 million Australians depend on it to participate in the economy, including more vulnerable groups and Australians in regional areas. Cash also continues to be used as a store of wealth, particularly during periods of economic uncertainty, and it can be a useful backup for electronic methods of payment. As a result, cash in circulation is around $105 billion. This is a record high. The RBA is committed to supporting the Australian Government's policy objective to ensure cash remains a viable means of payment for as long as Australians want or need to use it. Now, as you're probably aware, the cash distribution system has faced significant challenges over recent years. Lower transactional use has made it more costly to store, process and distribute cash. These issues are most pressing for rural and regional areas where these services are most expensive. As you may also know, the logistics of moving cash to bank branches, ATMs and retailers is undertaken by cash in transit companies, and the industry needs to work together towards a more sustainable distribution system. Linfox Armaguard, which is the main provider of these services, has faced financial strain and has been receiving industry funding for the past year. The Council of Financial Regulators, which I chair, together with the ACCC, have met several times this year to discuss the challenges the industry is facing. In July, the CFR and the ACCC jointly consulted on a proposed regulatory framework for cash distribution services. This would establish essential guardrails to support resilience and fair access to critical cash distribution services. The CFR and the ACCC are currently reviewing feedback from the consultation, and we expect to advise government on options on the design of a regulatory framework in the near future. As the issuer of Australian banknotes, the RBA also plays a key role in cash distribution. We provide banknotes to the major banks who distribute these to the broader community. We provide incentives to support the efficiency of distribution, encouraging banks to hold cash across the country, trade with each other and ensure notes of appropriate quality. We recognise that these arrangements need to adapt given changes in the industry, and so we are also reviewing the incentives we provide on wholesale banknotes to ensure they remain fit for purpose. And will continue to work with industry participants to develop solutions that will best meet the needs of the community. Finally, the RBA review. So this provided a valuable opportunity to reflect on the RBA's monetary policy analysis, decision-making and transparency. As you know, we've incorporated meaningful changes since the commencement of the new Monetary Policy Board, including press conferences after each meeting, publishing more information on our forecasts and our key judgments. The media statement following meetings has been issued by the board rather than the governor, and the minutes of the board meeting are providing a more fulsome record of the discussion. We've got an ongoing commitment to communication and transparency, and one recent change is to publish an unattributed record of votes in the post-meeting statement. I believe these changes have and will continue to be valuable in enhancing the communication and accountability of our decisions. The establishment of the Governance Board is also supporting the efforts we are making to strengthen the bank's management, culture and operations, including lifting risk management practices to meet the challenges of a modern central bank. And more generally, we've made substantial progress in responding to the recommendations of the review and to embed meaningful and lasting change. I think I can already see the impact of these changes. We're seeing signs of a cultural shift underpinned by a commitment to be more open and dynamic, which we will build on in coming years. While much has been achieved, we recognise that this is an ongoing journey of transformational change and continuous improvement for us. The Governance Board will report on our progress on achieving the objectives of the review by the end of the year. These changes are all designed to strengthen our ability to do our work and to enhance the welfare of the Australian people. So thank you for listening, and my colleagues and I look forward to answering your questions. Thank you, Chair.
Thanks so much, Governor. I just want to begin on reflecting on the statement that you just made. Obviously, there's a lot of material in there that's exceptionally important, but I do think it was important that the statement be made from the RBA acknowledging what Australians have gone through. They have gone through enormous pressure, and I think that element of your statement was critical to be able to express, so thank you for that. I noted earlier, Governor, if I may, I'll start with the questions and move to the Deputy Chair, the member for Cook. I noted earlier that in spite of some of these pressures, we've been able to perform relatively better than other economies, and our combined fight against inflation in particular has been crucial. Just wanted to focus on that, if I may, with a couple of questions. I might fire off a few and then follow up. How would you characterise where Australia is in terms of the fight against inflation? What progress has been made, and what were some of the biggest drivers of the recent moderation in inflation in Australia? So
I think we're in a very good position. As I said in the statement, we now have underlying and so we have this target range of 2 to 3%. The headline inflation's in fact been in target for some time, in that target range. But that's been impacted by cost of living relief, particularly in electricity, which has meant that the headline inflation, we don't think 100% reflects the underlying pulse of inflation. So that's why we've been focusing on what we call the underlying inflation rate. That's now back also under 3%. So I think we've made really good progress at 2.7%. It's not far from the midpoint of the range. And our forecasts, which are predicated on a further slight easing in policy, suggest that inflation is going to settle around the middle of the band. So I think we're in a very good position in terms of inflation. There's been a couple of things, I think, that have contributed to that disinflation process. The first point to make is that there wasn't a supply element in that. So you might recall that coming out of COVID, there were supply chain issues, particularly for goods, and then there was government support as well in terms for the populace. So people had support for those who lost their jobs during that period. And there was also a pent-up demand for services because people couldn't get out and go to restaurants and travel and so on. So as we came out of COVID, you had supply chain issues plus strong demand, and that led to lots of pressure on prices. So two things have happened. The supply chain issues have eased. Energy costs have eased. So you'll recall also during that period there was the Russian invasion of Ukraine, so energy prices rose very sharply. But also the rise in interest rates. We had to increase interest rates to remove the accommodation of monetary policy, and then we had to put interest rates into restrictive territory. And what we were deliberately trying to do was slow demand down. So that has also contributed to the disinflation that we've observed. So I think we're in a good position, but again, we do have to be alert because there's risks on both sides of this, and so we need to be very focused on the data, not just the backward-looking data, but also forward-looking data in this respect.
So on that, three quick questions around the data that you'll focus on. Which inflation measure will you focus on in the period ahead, headline or underlying? Which data is the bank finding more reliable, monthly or quarterly inflation data? And the other one is not a data question, but rather a global observation about parts of the world where inflation is still a problem or rising.
So we'll focus on both is the answer. We have been focusing on underlying to remove the volatile items. So we do think that still gives us a better idea of the underlying pulse of inflation. Having said that, our target is for headline inflation. Yeah. And ultimately what you expect over time is that the two will move together. Now, on the monthly quarterly issue, you might also know that the ABS are going to start releasing full monthly CPI from October number?
Yeah. It will come out in November for the month of October.
For the month of October. Now, so that's great. We're very happy that they're releasing a full monthly CPI because the monthly CPI indicator we get at the moment is only partial. Different months have different weights of different sorts of goods and services. So it's great to have a full monthly CPI, but it's also true that monthly data are more volatile. So while the ABS beds down over the next couple of years, the monthly CPI, particularly with respect to seasonal adjustment, we're still going to be relying very heavily on the quarterly numbers and particularly the quarterly trim mean, which is our measure of underlying our preferred measure of underlying. So it's going to be the monthly data is going to be good, but for us, I think we're still going to be, because of the volatility and the transition period to get it settled down, I think we'll still be focusing very heavily on the quarterly trim mean underlying to give us an idea of where the underlying pulse of inflation really is. On overseas, it's a little bit of a mixed bag overseas. Some countries, I think, are seeing inflation continuing to come down, but I'd have to say that some are observing, and I think the United Kingdom probably falls into this category, continued price pressures. Services is still an area where they're seeing continued price pressures. And the United States as well, you're starting to see some signs that there's tariff-related inflation there, but even abstracting from that, there is some services, strength in services inflation there. So I think everyone's comfortable that they've got inflation back down much closer to their targets, but I think there are sort of signs that we can't be complacent yet about where inflation is at overseas. Some other countries, I think Canada is in a slightly different situation. Canada has got, the unemployment rate has risen quite a lot, but they've got complications obviously with their trade relationships with the United States, which is impacting their economy. So I think they've got some challenges on their hands as well. So in general, inflation is coming back down, but there are still pockets, I think, overseas where, and that's where inflation is still evident, and I think that's where we have to be alert as well.
Terrific. Thank you. Moving to growth, 3 quick questions. Do you think the economy is growing in per capita terms? Which sector is currently the key driver of growth, private or public? And what are some of the factors that drove the recent pickup in private sector activity?
Sure. I might provide a bit of an overview, then I might pass to Sarah to provide a bit more detail. I think we are seeing growth per capita now. We weren't for some time. I think if you look at the level of GDP per capita, it sort of peaked in the COVID period with lots of income support, came off from that, but I think GDP per capita now is above pre-COVID levels, so it is higher. A lot of that in the recent times has been partly a public demand story, but in the recent quarters we think the private sector now start to respond. We are starting to see consumption respond, so I think that's very positive as well. And we have seen growth in employment in particular being reflected in what we call the non-market sector, but more recently we're starting to again see some of the market sector start to pick up as well. So I think there are signs that the handover from the public to the private is starting to happen, and that's what we've been predicting for some time. Real incomes are starting to grow again. People's wealth is rising, particularly as housing prices are rising, which also encourages people to consume. So that's positive, but there are risks. But I might pass to Sarah. You might want to make a couple of other comments.
Yeah. Thank you, Michelle. But yes, everything the Governor said, absolutely, that's what we can see in the data. And obviously, this is data that we're looking at that comes from the ABS directly. So we have now, we think, moved into a period where GDP per capita has started to rise again after a number of quarters where it was contracting or maybe flat in a particular quarter. In terms of the latest data and the drivers of that, consumer spending in particular picked up quite strongly in the 3 months through to the end of June. And consumer spending, the data can be choppy quarter to quarter, so you sort of have to look through the choppiness, but over the last sort of 3 or 4 quarters, we've generally seen a bit of a pickup. And that reflects a number of factors that are improving for households. We've now got wages growing in real terms, so that means that the annual increase in someone's pay is now larger in percentage terms than the increase in the price level, so they're able to purchase more in real terms. That's obviously a very favourable and positive development to see. As the Governor mentioned, we've got positive household wealth effects playing through as well. And we have had over through the 12 months to the end of June, we also had the Stage 3 tax cuts too, which were also helpful in terms of take-home pay. So all of those things together mean that household income now is growing very positively in real terms, and that's on a per capita basis or a per household basis as well as in aggregate. And that was we think that has flown through and supported consumer spending, and that was the main source of the pickup in private spending in the June quarter. Other aspects of private demand that have been a little bit softer recently, but had come off actually an earlier period of strength. Business investment in particular, it's been broadly flat over the last year. Different categories look different, and it chops up and down from quarter to quarter, but that's been broadly flat. And we've also seen a bit of a pickup in dwelling investment activity as well. That's building homes and alterations and additions as well. That being helped obviously by fairly strong demand in that sector, and more recently by interest rate cuts. We know that lower interest rates make more projects viable. And as the Governor outlined, the offset that we've seen just over the last 6 months or so has been with a slowing in the pace of growth of public spending, in particular government investment, that can be very choppy, but has actually fallen through the first half of this year. Current government consumption a bit flatter. So there is a bit of a transition, if you like, that looks like it's playing through. We've been expecting it to play out broadly in this way, so it's good that we're seeing what we expected actually coming to pass. And it does look as though we're in a cyclical upturn for the economy now.
Terrific, thank you. And my final question before I hand over to the Deputy Chair. I note in the Statement of Monetary Policy, the August issue, the bank observed business debt has remained strong and increasing to around, quote, its fastest pace since 2008 in nominal terms. What's the importance of that? What's driving it? And how much can be read into the potential for this to spur positive decisions around CapEx or business investment?
It's positive in the sense that obviously businesses that need to get credit to run their businesses can do so. So the financial system doesn't appear to be holding back businesses in that respect. More broadly, the relationship between business debt and investment is not a particularly strong one. Investment more generally tends to get financed by retained earnings. So it's not necessarily, we don't find it necessarily as a good indicator of what will happen with business investment. Things that are more important, I think, for business investment are, profitability, expectations for the economy going forward. You're not going to invest if you don't think that demand is going to be there to consume your goods. So there's a whole lot of factors. Can you get labour? These sorts of things. So these are the sorts of things I think that we think are a bit more important. Chris, is there anything to add on the business debt numbers from your perspective?
I think the growth you point out has been quite strong, and it actually started to pick up before we started cutting interest rates. I think that's fairly consistent with business funding being the cost not a constraint, and now that it's come down a bit through our interest rate cuts, even less of a constraint. The availability of funding's been pretty favourable, including from banks, but also non-banks competing more vigorously. And a large business, of course, can raise quite a bit of debt in wholesale markets, and funding there's been readily available as well. But even the smaller end of town is starting to see some benefits. So smaller business credit that growth is starting to pick up, having been flat for a really long time, so that's good. Businesses we talk to, small businesses particularly, still would sort of say there's quite a few constraints in getting access. That the cost for them is higher than for other businesses, and they still have to put forward quite a lot of good quality collateral, which they can struggle to do. But again, the Governor said internal funding is so much a bigger driver of investment, and external funding is helpful, but only a small part of that. So it doesn't correlate very strongly with business investment. And the main mechanism through lower interest rates is probably through increasing things like, as Sarah suggested, consumption growth, housing investment and so on. Businesses see that turning, and then they plan for more investment.
And to pick up on that, in terms of the outlook for business investment, we think that through the next year it'll be relatively flat. But again, to say it's coming off a relatively high base. We have very strong growth in business investment through 2022 and into 2023 that's connected with that reopening from COVID, and that burst of activity was very positive for businesses, so they expanded capacity to meet it. It's been a bit flat recently. We think that will continue for just a little while, and then we think it's going to pick up again, which is, as Chris said, correlated with and really driven by that pickup in activity. They respond to that and expand their capacity to meet that additional demand. So we're not expecting business investment to contract in a material sense over the next year, and then we think it will lift through the second half of 26 into 27.
Excellent. Thank you very much for that. I'll hand over to the Deputy Chair.
Thank you, Chair, and thanks, guys, for turning up today. My next couple of questions are going to be on productivity. Do you agree productivity has been the biggest driver of Australian living standards over the past 30 years? And then particularly over the last 3 years, we have it reducing more than 2%. Do you agree or not with that? And if you do, could you comment on the role public spending has played in that and the non-market sector?
So it is true that the driver of rising living standards is productivity. So as we've observed Australian living standards rising, by definition, that's because we've become more productive. So we can produce, with the same amount of labour and capital, we can produce more. And so obviously that's good for us and it's good for our living standards. It's also true that I don't think productivity has, it's about its 2016 levels, is that right, Sarah? So it really hasn't, it's, if you look at it as a level, it goes all over the place. It goes right up, ironically, in COVID, because a lot of the sectors with relatively low productivity, which were service sector, they all closed down, so productivity went up. Then when they all reopened, it collapsed again. So it's been all over the place. So so I think you need to draw a sort of a line through all of that and just think about it, not in a quarterly sense, but in a longer run sense. You will also probably, you may know, that in our most recent forecast we downgraded our medium-term productivity assumption for the purpose of our forecast from 1% to 0.7% annually. Yep. And that was done on the basis that we had been thinking for some time that the productivity assumption, obviously we weren't meeting it, but secondly, some of the data, we were sort of meeting employment and inflation outcomes, but we were overestimating our demand. We were coming in lower on demand than we thought we should be. So we've sort of think that this sort of helps to resolve the puzzle of why we were sort of hitting inflation and employment forecasts but not hitting other parts of our forecast. So we think it's consistent, and as I emphasise, it's really just for the duration of these forecasts. It's a couple of years. The importance of making sure, and the government recognises this, the importance of trying to drive growth in productivity is paramount. That's as we said. That's why we. It's the reason we have our living standards increasing. If we don't get productivity growing, we won't have good rises in real wages. On the role of public spending, I think maybe you're referring to the extent to which some of the industries in which are expanding, and they rely on public. So which I'm thinking of aged care, I'm thinking of NDIS, I'm thinking of health, education, all those sorts of things. All those sorts of areas do have lower measured productivity, but they are all essential parts of an advanced economy, and our demographics are playing a role here as well. So we need all these sorts of things. So I don't think you can sort of make a correlation between more public spending on these things is bad for Australia. I don't think you can do that, but it does mean that we have to look for productivity improvements in other areas if we can get them. So this is sort of the challenge, I think, for the economy, the government, businesses. It's not just the role of government to look for productivity improvements, it's also the role of business to look for productivity improvements. And I think some of the evidence that we've had in recent times has been that Australian businesses haven't had the dynamism that some other industries overseas. We haven't been sitting at the frontier, the innovation frontier. So there's plenty of evidence to suggest that we could do better and businesses could do better here. Yes, there's a role for government in some ways, but businesses have to step up as well. Anything you want to add?
Yeah, maybe just a couple of points, and I might just point the committee if you haven't already, and I know it's not the best bedtime reading, but we did put out a special paper as part of our August SNP that talked about the productivity outturn that we've seen and why we've made the adjustment to our assumption that the Governor outlined. So my team would love it if you gave that a read. Just a couple of points to add on the sectoral composition and explaining some of the very recent weakness. There are actually a number of things flowing through the economy that are pulling that number down in terms of the growth rate. The Governor noted that reopening from COVID and the sort of mechanical effect that have. It's really clear. You can see it quite clearly on the charts. There is another sort of mechanical effect playing through that perhaps gets a little less attention. The mining sector is going through a period of falling productivity growth. That's not atypical for that sector. It has its very own unique cycle, tends to be disconnected from the rest of the economy for obvious reasons. It's quite a separate sector to the economy. It's playing into the international market largely, the vast majority, rather than domestic. And so that's been happening as well and putting down on that aggregate figure. And as the Governor mentioned, there's that compositional effect as well from non-market, the growth in the non-market sector. And then the final point I'd add around the non-market sector and some of the examples that the Governor mentioned. The way we measure productivity in the national accounts data, it's very mechanical. So, and particularly for those sectors, we count the inputs, so the people working there and the wage that they're paid, any capital that might be used, but it's mostly people, they're people-heavy industries. And because they don't have a market price, that includes in the name, non-market sector, we can't put a proper value on them, so their value effectively becomes the value of their inputs. So that sector, if you look over the last 30, 40 years, the ABS has this chart, it's a really nice one, effectively it's zero growth in productivity in that sector because of how we measure it. Now, you can imagine actually outcomes in that sector may well have improved on a more holistic definition. The Productivity Commission put out a paper, I believe it was early last year, that looked at the healthcare sector in particular and called out improvements in quality outcomes and shorter hospital stays for all kinds of surgeries, for example, better cancer treatment outcomes, all these sorts of things. These have happened over the last 30 years. We've probably all got an example we can tell ourselves, but they're not captured in the data that we're looking at. So you do have to be a little bit careful with how you look at the numbers.
And just, you know, in that August SMP, I think, and I did have a read of some of it, I think you used the words public demand is supporting growth and public consumption is a larger share of GDP for most periods since the 1960s, talking about the current period. And noting what you say about the value of those sectors, not disputing that, noting what you say about the measurement challenges of some of those sectors. If you just take a mathematical perspective of the last 3 years, and I think it's down about 2.25% in the last 3 years, and you look at sector by sector, I note what you say on mining, but when you look at some of those sectors you mentioned, Governor, aged care, NDIS, some of them have actually had negative productivity, not even just being flat, I believe. So if you look at why, just from a mathematics point of view, why we've had that negative productivity isn't the contribution, it's the growth in those sectors relative to the market sector. Is that what's going on mathematically, or am I missing something?
I think that's what Sarah was saying. Mathematically, that's sort of what's happening. But
yes,
I guess what I was trying to say was don't correlate that to say in order to get productivity up, we have to dramatically increase the size of the non-market sector. I wouldn't want anyone to make that connection.
But mathematically, we're
there
losing
is
productivity because of that increased spending in those sectors.
If as Sarah said, if you look at across the economy, if you look at different areas, if a lower level of productivity, if a sector with lower productivity in terms of levels grows in size, then it mathematically brings down the
productivity. And just to follow on that, I think the PBO last Thursday published its predictions, and I think it had deficits up for the next decade. And my reading of that, the only way the PBO has those budget deficits being erased is two things, both which seem a little bit troubling to me. One is bracket creep. So we're essentially just taxing more, and actually maybe you could comment on if that is true and the PBO's analysis is true, what that means for intergenerational Australians, tomorrow's taxpayers and young people of today. Well, the other one, which you mentioned, Governor, is forecasts of productivity. I know Treasury's got a forecast of 1.2%. I think you were talking 0.7%, 0.7%. Looking at that, I think I read debt will go even higher, 40% of GDP. So I guess the specific question is, maybe you can firstly, is it correct that the PBO has deficits for the next decade? And really, it looks like from their analysis, there's only two ways out of that. Does this agree or differ with what you're finding? Either we're taxing Australians a lot more through bracket creep, that's how we get out of it, or the other one, if the productivity assumption is wrong and they're closer to where you are, it's going to be even worse. Am I reading that and understanding that correctly?
Well, I'm not across the PBO estimates, and we don't have our own estimates. Yeah. We just basically take whatever Treasury have for their estimates. So maybe you could explain.
Yes, so just to pick up on that, and I haven't seen that PBO analysis either, so I can't comment on that specifically. But yes, just to be clear, we take all of the fiscal settings, that's the expenditure side, the tax side, as given. They are government policy. We would take those and input those into our forecast, but we don't take any view on how they might evolve over time. So it's whatever's been announced and has been legislated, that's what we include. And so we're not in a position to comment on the PBO's analysis or indeed on Treasury's analysis. That's for them to talk to. In terms of the outlook for productivity growth, and actually just to pick up a little bit on your previous comments, so we do, in that SMP chapter, we do talk about specifically the last couple of years for non-market sector growth and what that's mechanically done to the forecast. Yep. It's added an additional 0.15 percentage points drag, so that's not a very large drag actually. Got it. That sector, generally speaking, has been getting larger over time. You can see that in the data, so it's all that sort of effect you're talking about is always there. It's been a little bit bigger just recently, but it's not actually explaining most of it. And then
just
finally,
on that question, I'm sorry to interrupt, just because I'm watching my time and I'm almost at there. Just on the question asked, do you have any view on the intergenerational impact on the economy of bracket creep and that doing if we are wrong? And just on that, has that been discussed? Do you guys look at that? Tax burden.
It's nothing that we can do anything about. Yes. The Reserve Bank, we have to take that as given. As a citizen, do I worry about intergenerational issues? Yes, I do. I have children. But we at the Reserve Bank, we can't impact this ourselves. And these decisions on the forecast of productivity, I think we've been very clear that this is just our for our forecast period. We're not saying that there mightn't be changes that might bring productivity growth up. That's for Treasury and the government to work on. It's only a short run. We're not casting a view on what the longer run forecast for productivity will be.
And just to say that point, I suppose, in a different way, but I absolutely agree with what the Governor's just said. A 2-year horizon for productivity is very, very short. You said yourself earlier, you're talking decades, really, to see material changes and for those changes to have an impact, and they do matter. But the kind of analysis that PBO have done and that you would see from Treasury and, for example, in the intergenerational report are looking over very long periods of time. It's a different time horizon, and they obviously construct their assumption in a different way. We're very anchored on just the 2 years that we're concerned about from the economic cycle perspective.
Last question, or we have time?
You've got a minute.
Okay, last question quickly. Council of Financial Regulators, I know you chair that, you mentioned that earlier. I've noticed over the last 20 years the balance between business loans and home loans is sort of inverted. 20 years ago it was $2 for every business to $1 home loan, that's now switched. Is this something you discuss at that council with APRA and others, and what effect that may be having on the economy versus, putting money into a probably less productive housing sector versus business lending? And have you guys discussing that and have any thoughts or strategies in your last meetings?
Quick answer is a good answer.
Quick answer is a good answer. Look, we have observed that, and it's true that the Australian banks are very heavily weighted towards housing, and I think part of the response, as Chris mentioned earlier, non-banks have started to step into the business loan business because the housing loan business is very competitive within the banks. So, yes, we do discuss it. issues to do with risk weights and so on that people might think might affect that there for APRA, but it is something that we discuss and we observe over time.
Tremendous. Member for Wentworth, over to you for 10 minutes.
Thank you very much. Well, I'm going to actually start where the Deputy Chair left off. I guess the question is really, does the RBA have a view as to why this has happened over the last 20 years, that we have had this shift from bank lending 2/3 dominated by business, 1/3 housing, to 1/3 business, 2/3 housing?
Well, I think partly it's been a response to the way that regulation has moved, and we have unquestionably strong is APRA's mandate here, and it's true that risk weights for owner-occupied housing encourage lending for housing. That's true. There is work going on to try and look at risk weightings, I know, in APRA for business, but for banks, there's very low default rates on housing. It's favourably risk weighted, and there's a lot of demand for it. And I think that's why the banks have responded. It's become a very competitive industry, I'd have to say, but I think it's partly a result of a response to the global financial crisis, where we tried to strengthen the banks, and partly they've responded by directing financing to less risky things such as finance. So, Brad, do you have anything to add?
Yeah, there are a few frictions that are just sort of inherent to lending to businesses. You don't have the same sort of standardisation that you do with mortgages, so it's just operationally easier for the banks to get their arms around that. You don't have the same scalability even across firms of different sizes, and there's big what they call informational asymmetries or frictions that make it a little bit harder for banks to have the same level of visibility into the finances of firms as distinct from households. And the survival rates of firms, particularly smaller firms, is just lower than for large firms and large firms compared to mortgagees. So there's all of those things together just mean that it's tougher for banks to do, but as the Governor said, partly in response to that, we are now seeing a response in other parts of the financial system, a rise of private credit and non-banks starting to fill that gap that the banks have stepped back from.
Can I just add two things as well? I mean, going back to my earlier comments, I think it's true for some businesses the availability of funding may have constrained their ability to expand at the margin, particularly some of the smaller businesses that do need high quality collateral to overcome those informational problems. But for business sector as a whole, I wouldn't say that business investment has been constrained by the availability of funding, because so much of that's generated internally.
It's actually particularly the smaller businesses I'm most interested in, because those are the ones who have the greatest challenges from, in your own charts in terms of access to capital. I'm interested into knowing, any perspectives on, do other countries do this differently or better in terms of helping small businesses access this capital, and what are the implications of a banking system or a credit system which is so weighted to housing? What are the implications in terms of productivity and business dynamism?
Yeah. Well, certainly there is a lot of small businesses, in fact, the way they get their credit for their business is by mortgaging their house. Mm-hmm. So their collateral is their house. Yep. So there's that part of it. I think in some other countries, venture capital is much more prevalent, isn't it?
But I think it's pretty universal that other economies see small businesses struggle to get access to finance for very similar reasons. The UK, Canada and so on, there are a lot of parallels between us and them. So, I mean, it is tricky for them to get debt finance without collateral at very favourable terms.
Just to add to your sort of point around what are the outcomes in other countries, particularly around productivity, we're not alone in this challenge, and with the exception of the US, and even in the US, they have seen their pace of productivity grow slow over the last 30 years, but they still, in absolute terms, outperform pretty much every other advanced economy. But if we compare ourselves to Europe and some of the advanced economies across Asia, we don't actually look that bad. In fact, we look probably better than average on a longer term basis. So the last period has been very weak, the last decade or so in particular, but on a longer period than that, we don't look like we're particularly underperforming. It does seem as though there are a lot of probably little things that are adding up into one big thing, which is the aggregate thing that we can measure. But it is very hard to put your finger on one thing in particular that will solve the problem in a material way. It feels like lots of little things, and I think this conversation about business credit is a really good example of that. Probably could be better, but it's probably not going to solve the problem in and of itself.
I think so. I wanted to talk then to move to another big issue that Australians, and particularly younger Australians, worry about, and which is the cost of housing. And specifically, you know, whether in previous hearings we've heard a lot about, you know, this is a supply challenge. You know, we need to keep focus on supply to keep housing affordable. You know, in the bank's view, is supply meeting the sort of growth and demand that we are seeing in housing, and particularly recent policies such as, I'm interested if the RBA is modelling things like the recent deposit scheme change that the government has put forward in terms of which is going to come into effect in October, and to see, is that going to have any impact on housing sort of demand or anything? What's your perspective on this?
So first point is, yes, you're absolutely right, it is a supply issue, and are we close to meeting it? I think all estimates I've seen is that we are not. I think there's a couple of things that have happened, and Sarah's highlighted this in the previous speech. Demand for housing it's new households being formed, but it's also the size of the households that are there. So if and we've had declining household size over many, many years. And in fact, when COVID hit, it fell even further. It's since come back a bit. But the point of all that is that for a given housing stock, if your average household size is declining, then you've got more demand effectively on the same stock of housing. So that's the challenge. It's partly it's certainly supply is an issue. But demand is impacted not just by, you know, the number of new households being formed. It's actually the average household size, which is impacting as well. So we do really need response on the supply side, and I'd have to say the governments are all aware of that. And you know, New South Wales government has recently reacted very strongly to this. Other governments, I think, are also thinking about how they address this issue. The deposit scheme thing is more a demand side thing. We have done a little bit of work on this, Brad.
Yeah, so just purely on the demand side, most of the estimates out there, including from Treasury, suggest that almost by definition, because of the way the policy is set up, it will bring forward more purchases and increase the borrowing capacity of first home buyers. Our sense is that it could add to overall housing credit in the order of 1 to 2%. At the very margin, you may see a little more upward pressure on house prices in the short term, recognising that first home buyers account for about 20% of the flow of new housing credit. But Treasury have also done some work on medium-term supply response, and their sense is that you will see over time an uplift in supply in response to that extra demand as well, and so that will end up dampening the price effect over the medium term.
Sure, thank you. And I guess our last question was just around coming back to productivity. I noted from some McKinsey analysis that productivity in the finance sector has dropped to 0.7, has been negative 0.7% since 2016. Do you have any comments or reflections on that? I've got about 30 seconds on that, so very short. Chair's keeping us very tight here.
I have no particular reflections on that. I guess the only point I would make is that ultimately some of the AI developments might help in that particular sector, but we'll have to wait and see.
Okay, thank you.
Very good. Over to you, Member for Bennelong, Jerome Lexale.
Thank you, Chair. Thank
10
you,
minutes.
Unsurprisingly, I've got some questions on payments. I'll get straight into it, noting our time requests. The new Chief Executive of the Australian Banking Association recently suggested that your proposed interchange fee reductions will, and I quote, undermine the capacity to keep safe and secure the very thing that everyday Australians rely upon. What are your thoughts on sort of this correlation between your proposals and the banking sector's requirement to keep the payment system safe?
Somewhat surprised, I guess, is what I would say. If you look into the detail of it, fraud prevention is part of what we would consider our relevant costs that could be recovered by interchange. And this is what the argument is about. It's about interchange. It's about how much money issuers get when you go and you use particularly your credit card. That's what this argument is about. So I think it's extremely unlikely that they're going to shoot themselves in the foot by removing fraud protections or anything else like that. I think that I can't understand why they would even suggest they would do that. So when interchange was lowered initially back in firstly in the early 2000s, it wasn't fraud that actually expenditure on fraud reduction that got curtailed. It was loyalty points, and I would expect a very similar thing this time.
So why do you think they've lent in so hard on the fraud? Do you think they're like trying to call your bluff here? Because the NAB have directly linked your proposed reforms to reducing fraud protection. Visa warns that the proposal would severely constrain the ability to continue to support the resiliency and security. I mean, they're pretty strong threats. ANZ has implied that a reduced interchange could jeopardise acceptable investment in fraud. To me, these seems like empty threats. Like, would that approach be consistent with your expectations of them? No,
it's not. And as I said, if you look at our cost study information that we published, fraud costs, which are in there, are an eligible cost. So the sort of money they spend on investment in fraud detection and so on, that is part of which we say, well, yes, you can use interchange. That's a relevant use of interchange to take those costs. So I think that they are obviously looking for ways to push back on the reduction in interchange because that is revenue to issuers, and so in a sense, I don't think that actually will happen myself, but you know, I sort of understand, I suppose, why they are saying that, but I don't think it's a very good argument.
Sort of what obligations do banks and payment providers have to keep these systems safe and secure?
Well, they have a very strong obligation to do so, and it's in their interest to do so, because if fraud detection isn't a part of these, then people aren't going to use them. I mean, you need a safe and secure payment system to encourage people to use it. So if you end up with a payment system where people aren't investing in these sorts of things, they'll stop using it. And there's other alternatives.
And just to be clear, does that obligation to customers weaken if the banks become less profitable?
Well, again, it's not in their interests if they have to fund more of this to keep the payment system working, then that's part of where they do still make money out of this. You know, so I think this idea that somehow they're going to be losing money on this, I really don't understand that argument at all. They provide these services, these cards, and they make their money back through a variety of ways, and curtailing fraud protection to try and save money ultimately will not be good for them, and it won't be good for the payment system. So I don't think that it's something that realistically we would see.
The Scam Preventions Framework, January 25, is intended to stop scams by requiring regulated businesses to take reasonable steps to prevent, detect and disrupt scams. If they don't meet their obligations, they can face fines up to $50 million. Do you think it would be reasonable for banks to lower spending on fraud and scam preventions if their profitability is impacted by the payments and surcharges review?
Well, again, no, I don't. But again, because it's in their interests to have a payment system which is safe from fraud and scams. That's in their interests.
Thank you. You mentioned eligible and non-eligible elements of the interchange cost. Can you explain? So you've identified in your cost study and way back in 2002 that rewards points and I'll focus on reward points, but others are non-eligible costs. But again, we have this sort of threat and this clear link between interchange and rewards. Why do you see it as a non-eligible cost? And why do banks see it as an eligible cost?
So let me go right back to why we focused on interchange in the first place back in the late 1990s, early 2000s. At the time, we had credit cards the use of credit cards was rising by about 30% a year. And debit cards, there was FPOS debit cards, and Visa and MasterCard debit cards were really not in the picture at all. It was Visa and MasterCard credit and FPOS debit. That's what you had. And FPOS debit, as an interesting piece of information, interchange flowed the other direction. Interchange was paid to the merchant's bank and then was refunded to the merchant. So it ran the exact opposite direction of credit cards. What was happening was that credit cards, the interchange revenue from that was being used to fund loyalty points. So in effect, the price signal on a credit card was saying, I get paid money to use a credit card, why wouldn't I use it? And our cost studies said, but credit cards are more expensive than debit cards. Why would you have a price signal that encouraged you to use credit over debit? So that was sort of the gist of where we started from. So why are eligible costs? Why are loyalty points, in our view, not eligible costs? They're basically to encourage people to use a credit card, and with the rise of debit cards now, in fact, credit cards aren't the predominant payment, but the people who use them are wealthier, they have higher incomes, they use the interest-free period, so they don't pay any interest, and they get loyalty points. So in effect, the higher interchange that's funding those is being paid by everyone, and it's funding people who are wealthier, higher incomes, to get loyalty points. That's why it's not an eligible cost. That doesn't seem like a sensible way to incentivise the payment system, and that's why we don't think that the cost of loyalty points should be included as an eligible cost for interchange.
They do, though, right? They're in most of their, in most of their consultation paper responses in the submissions, they're like, you know, we'll take your rewards points away if you touch interchange.
Yeah, and if they do, they do. Yeah. And again, back to the point, the loyalty points are giving a signal to a certain group of people: use your credit card as much as you can, even though it's more costly than a debit card. Use it as much as you can, and the merchants pay more for those credit card transactions, so that's baked into their prices. And who is paying those higher prices? It's the consumers that don't use the credit cards.
Which are particularly younger people, aren't they?
Younger people with debit cards, people
lower incomes.
Lower income. Yeah.
1 minute. I've got about 45 minutes worth of questions here.
You have a thank you card to be old.
We've just last very quickly. We've spoken about blended pricing. I noticed in your and I note this is your draft position, and you know there may be movement, there may not be, but you didn't seek to address that in your draft proposal in terms of breaking that down. I mean, personally, I see that as a reason why we've got sort of this distorted. I mean, that's why least cost routing, I think, doesn't really work. And that's why I think small businesses in particular are getting surcharged.
Well,
How did you look at it?
We haven't addressed the blended pricing issue because we've basically said the blended pricing was resulting in a surcharging regime which wasn't giving a price signal anymore.
Right.
So in saying, in the position we've taken, which is, look, let's simplify things, let's just not allow surcharging anymore, the blended pricing issue in effect goes away. It's a cost of business now for businesses, and it's just like, more or less like electricity. It just gets folded into the.
Thank you. Member for Casey.
Thank you, Chair. Thank you, Governor. Just on, you talked about earlier the temporary energy relief, and so just noting that the ABS had electricity up 13.1% for the 12 months to July and 13% in the month of July. And one of the reasons, or the reason it stated, particularly in the July number, was that there was no temporary relief measures. So wondering, have you modelled the ongoing impact to inflation once the temporary relief comes off? And can Australians expect double-digit electricity bill increases moving forward once those rebates are no longer there?
So the rebates impact in the most recent inflation figures, the rebate impacts were, the timing was a little bit different than we were expecting. So, but my understanding is that the federal government rebates are extended out to the end of the year now, aren't they, Sarah?
Correct. So my question is, come January next year, once there's no more rebates, as it is today, we've seen 1 month where they didn't exist. We had 13% increase. So can we expect there will be 13-14% increases next year once they go away, and have you modelled that?
So you have to distinguish here between the increase in energy prices ongoing and the rebate thing itself. So even if energy prices did not increase, say they were stable, then when the rebates come in, it drops to the consumer and then it goes up to the consumer. That's, so when it comes off, that's a distinction. Yes, it goes up when the rebate comes off. That's the way it works.
Maybe just to elaborate a little bit and to talk about what we've modelled in a technical sense, because we have looked at this.
I understand how the rebates work. I more want to look at the impact next year for consumers.
So as the Governor said, we've got sort of two timings for when these rebates roll off. The state rebates have now rolled off. The ones that were in place, not all states had them, but some states did. They rolled off at the end of June this year. And then we have 6 months at the back half of this year, the July to December period. We still have the federal rebate in place, and then that will roll off come 1st of January. So as the Governor mentioned, there are timing issues with when the federal rebate does and doesn't appear on people's bills, but effectively you can imagine it as we've got a step up in July, August this year, big step up in July. We were expecting that, and we saw that coming through in the monthly CPI indicator. That will then sort of carry through, and what we think is that overall headline inflation will peak at the start of next year around about 3%, which is when the federal rebate will also have rolled off, and then it will gradually fall back down as we work through a 12-month cycle.
So just
in terms of
how we, for the sake of time,
in terms of how we model, in terms of how we model electricity
consumers
prices
can expect an increase in their electricity bills in Q1 of next year, is what you've just said, which is
what they pay.
Yeah,
they will expect a rise in what they have to pay out of pocket.
That answers my question. Can I move on to another issue, because I've only got 10 minutes? You've answered the question that I was asking, so I really appreciate that. I just want to move to surcharging, keep the member for Bennelong happy. We all want consumers to pay less. However, I'm always concerned about unintended consequences around banning the surcharging. So RMIT finance professor Angel Zong told ABC News that in practice, these changes could increase banking costs and leave Australian consumers footing the bill. According to the professor, banks will lose about $90 million in revenue each year, meaning they increase costs in other ways and pass that on to consumers. He went on to add that surcharges are already banned in Europe and the United Kingdom, and that research into the international experience demonstrated a potential for increased costs to be passed on to consumers here in Australia. COSBOA also raised concerns saying that if interchange fees go down, things like terminal costs will likely go up to recoup the costs. They also added that small businesses are not in a position to simply absorb increased costs from banks, and that any new fees would be passed on to consumers in the form of increased costs of goods and services. So my question is, do the RBA think that this change will achieve its intended policy objectives if interchange fees are levied in other ways and ultimately businesses pass on these costs to consumers by way of other increased costs of goods and services?
Okay, so there's so much in there which is misleading and sometimes wrong that I don't even know where to start. Let me just make this point. The payment system as a whole has a certain amount of costs associated with it, and someone has to pay, and it will be ultimately the consumer. It depends on how they pay. So the comment that somehow so what we've tried to do in the reforms is say we will not allow surcharging, but what we're going to do is we're going to try and lower the costs that merchants pay by lowering interchange, which should reduce the pressure for them because they feel they have to surcharge to recoup those costs. That will reduce the pressure on them. The fact that we lower interchange isn't going to make acquirers raise costs for merchants. That's not the way it will work. So what we've got to do is introduce more competition in this area, and that's where the transparency things come in. So really what we're trying to do is increase competition for acquiring service, which will lower costs to merchants, which will mean that the fact that they can't surcharge won't matter as much because the costs aren't high. So that's the gist of it.
So they'll move to cost. So if we move then to least cost routing, and so we know lower interchange fees can be paid through least cost routing, and the RBA has acknowledged that while considerable progress has been made, the payments industry has more work to do to provide and promote least cost routing. The RBA is taking further action to ensure that LCR will be available for all merchants, and that's a quote from the RBA. So what more could be done to improve the least cost routing, and will the RBA consider requiring payment service providers to utilise dynamic least cost routing to reduce digital payment costs to their lowest possible amount?
So dynamic least cost routing is quite expensive to implement, and there's a question about whether or not the benefits would outweigh the costs in those circumstances. What we're generally trying to do with all of these reforms is lower the costs that merchants have to pay, and what we've been observing is that with the current surcharging arrangements is that merchants get blended rates. It doesn't matter whether they pay by credit card, Visa debit or EFTPOS, it's the same rate. So least cost routing doesn't really be reflected, isn't reflected in what merchant pays. And then the acquirer basically says to the merchant, but don't worry about what you pay, just surcharge, and then no one's... So this is the problem with it. It's not transparent. It's not giving price signals. And so this is the reason why we think we have got least cost routing working pretty well in a face-to-face environment. We are working on it in an online environment as well. And if we can continue to, I think, do that, the dynamic side of things, I think, won't really be needed, because I think if you weigh up the costs of enforcing that, I think that would outweigh the benefits.
And I think last question, just around competition. So a core pillar of the RBA's mandate is to promote competition and efficiency in the payment system, as you've referenced, Governor. So yet in response to a Senate Economics Committee last year, the RBA admitted that it had not, and I quote, not undertaken analysis of the effect on competition and market concentration in the consumer credit market of its proposed surcharge and interchange change. So I'm just wondering, has the RBA undertaken any analysis since that time? And if you have, what did the analysis show? And if not, why not, as it's a core pillar of the RBA's mandate?
I don't recall that comment in the context of that comment in the Senate. I suspect, I don't know, but I think it's because it's before we released our consultation document on all this information, and we've now got fulsome information out there on the consultation of surcharging and merchant payment costs. So
you have done analysis on the effects of competition and market concentration in the consumer credit market?
What do you mean by consumer credit? You mean borrowing? You mean consumers borrowing?
Credit cards, debit payment, the payment system that we're talking about. Have you done the analysis on competition in the payment system in credit cards, debit cards, Apple Pay, consumer credit?
We have done some work on, as I said, with the consultation document on what this would mean for competition and efficiency, these proposals we are putting in place. And in that context, we've done some work on big issuers and small issuers and so on. So yes, we have done some work on that. Apple Pay so far has been outside of our remit because we haven't had the powers to address them. But those are the sorts of things we'll be looking at going forward.
Okay, Member for Reid. Sally Situ.
I'd like to move the discussion onto a global outlook, and I know that in your opening remarks you stated that uncertainty was a big challenge to economic forecasts. I'd like to just kind of tease out some of the risks that you see. I know there's been a lot of focus on US tariffs, which would love you to touch on, but also explore some of the other challenges that you see coming on the horizon.
Yeah. So we are seeing a really marked change, a step change in the world trading system. It's a marked change, and it's yet to play out, and it's going to play out over the next few years. It's not something that's going to sort of all the outcomes are going to be evident in the next few months or so. It's going to be a big change. In our was it our May statement on monetary policy, we put in a scenario which was quite a catastrophic scenario, which was effectively a big world trade war. We don't actually think that that's where things are heading. If you look at what's happening with the tariffs so far, is that the average tariff on US goods, the effective tariff rate in the United States has gone from about 2 or 3% to about 18%, something of that order. But what we haven't observed is a retaliation by other countries. And so the effective tariff rate across the world is actually it's risen, but not nearly as much. It's only risen to about 3 or 4%, something like that. So we think that there are going to be implications of that, and we haven't, I don't think, seen what those are yet. As I said, I think that's going to play out over time. We do know that world trade is going to shift, and we are already seeing world trade patterns move and shift in response to that. What that means for Australia is not 100% clear. We know that we are not really going to be badly directly impacted by tariffs from the US on us. So our focus has been much more on what's happening to our major trading partners, including particularly China, and the extent to which they are impacted by the change in the world trading order, and does that impact their growth, and therefore does that impact us? So that's really been more of our focus. A few other things, I guess, sort of going on that are on my mind. There's all the geopolitics going on, of course, the potential impacts of that. It usually crops up in energy prices, but it could crop up in other ways, the spread of wars. The other thing that I think is quite important here is, and this is again related to the geopolitical thing, is the cyber side of things and the potential operational risks which stem not just for us but around the globe. And then there's the potential financial stability risks, which we're going to be talking about a little bit in our financial stability review in a couple of weeks. The markets seem very sanguine at the moment about all of this. There isn't a great deal of risk priced into equities. Certainly higher credit risk companies don't seem to be observing high credit risks, high risk in their borrowings. So I think there's a sort of a slight concern that if things quickly turn in a bad direction, that the markets might react quite badly, and that might not be good for financial stability. So I think there's a few things that are sort of in the mix for us.
Thank you. And given all those risks that you foresee, I note that you also said monetary policy is well placed to respond if it seems international developments could have a material impact on Australia's economy. Why do you think that's the case, and how do you think Australia's situated to deal with the risks that might be coming?
So I think in that context, what I was referring to was the fact that, you know, the interest rate's still at 3.6%. Prior to COVID, our interest rate, our cash rate was about 1.5%. So there wasn't much room to move when circumstances changed negatively. So we have got room to move if, for example, the world trading system ends up badly impacting China, that badly impacts us. We've got room to lower the interest rate further, ease monetary policy further. So I think we've got that flexibility, and that's something that, as I said, we didn't really have pre-COVID. So we're sort of in a good position. We've got a pretty strong labour market still. Inflation is back in the band. The interest rate's still at 3.6%, and therefore we've got room to move if we need to.
We've kind of focused quite a bit on the risk side of things. I'm keen to just get some quick thoughts on where you might see opportunities for growth that the Australian economy can tap into as well.
Well, I'm probably not... I guess I'd channel some of the work that the Productivity Commission has been doing on some of these things, but I think the green energy transition is obviously one where there's a big opportunity for us, I think. I think we've got some work to do, I think, in terms of how we utilise AI and those sorts of things. I'm a bit of an optimist that I think that will be ultimately, I think if we use it positively, I think there's some opportunities there, as there are for other countries as well, but I think we could position ourselves well there. It's going to change the nature and the shape of the labour force probably. As history demonstrates, this does happen as you get different technologies coming in, but I think that's another potential opportunity for us. So there's just a couple of thoughts, but you know, there's lots of work from the Productivity Commission on the sorts of things that we could be focusing on as a country.
Just to add to that briefly, we don't necessarily have a strong view on this because obviously we are very short-term focused, but one thing that we do track and look at and can see is the composition of the sort of pipeline of projects that businesses are contemplating. Big projects, small things don't appear, but big projects. And exactly what the Governor's just mentioned, those types of projects are in the pipeline. So renewable energy investment, for example, from the private sector is something we can see in the pipeline. And we can also see the last few years there's been a lot of investment in warehousing space, which is where data centres would show up, for example, but also the automation of retail and things like that, another example of productivity growth. So actually what we mostly look at is what businesses decide to do and therefore decide not to do as well. Where are they not investing now that they perhaps did 10, 20, 30 years ago? And we can see some of those new sectors at least planned for at the moment.
Yeah, fantastic. I'll just ask one last question, Chair.
You're doing very well.
You noted that inflation and then subsequent changes to interest rates have a disproportionate impact on low-income earners. How does that factor into your decision-making process when it comes to monetary policy? And do you have the data required to really understand how that group is being impacted?
So we understand that monetary policy has distributional impacts. It does impact different people differently. And when interest rates are going up, obviously hurts people who have debt and mortgages in particular. And when they're going down, I get a lot of emails from retirees and people who are earning money from interest, that sort of thing. So we understand that, but the way monetary policy works, I think people focus very much on what they call the cash flow channel. So if you put interest rates up, people who have mortgages have less to spend and that impacts demand. But it doesn't just work through that route. It also works because when you put interest rates up, it encourages people to save rather than to spend generally. And it also works, the exchange rate moves as well. So if interest rates are a bit higher, the exchange rate is a bit higher than it would otherwise be, which means import prices are not as high as they might be. So there's other angles through which these things work. Now, having said that, we do think about distributional impacts, and we do estimates, particularly in the Financial Stability Review, looking at the impact of interest rate rises on households that have mortgages and the amount of stress they're under. So we do have estimates of that. Ultimately, though, we have to set an interest rate which is right for the economy as a whole because, as I've said a number of times, yes, higher interest rates impact people with mortgages, but inflation impacts everyone. And particularly those who don't have mortgages are on lower incomes. They are the ones that are really badly impacted by inflation. So we can consider it, we do have information on it, we do look at it, but ultimately we have to set what we think is the right thing for the economy as a whole.
Terrific. Okay, we'll go to lunch. I'm really happy that we're going to lunch now because Sydney Morning Herald's Shane Wright just came in and we're shutting the committee down. So, so we'll break now, return and start just a shade after 12:45, if that's okay.
Yep.
Thank you very much. Thanks, everyone.
Thanks, Chair.
Terrific. Okay, thank you. We now resume following that very short break, and I'll hand over to the member for Bowman, Henry Pike, for 10 minutes.
Thank you, Chair. Governor, you mentioned earlier the tariff-related risks for inflation in the US, and the Reserve Bank has recently been highlighting the negative effects that tariff and protectionism has had on global growth and Australia's economic strength, stressing the importance of open and free trade. Now, there has been a lot of commentary recently on the prospect of Australia introducing so-called climate tariffs on imports such as cement, steel, lime and other emissions-heavy goods. Has the RBA conducted any scenario analysis on how such measures could affect Australia's economy, prices and competitiveness? And more broadly, do you see a risk that these types of tariffs could distort trade patterns and undermine the openness that's benefited Australia's economy for so long?
So I think the answer is no. We haven't conducted any analysis of that. Are you referring? I'm assuming you're referring to something like the Europeans impose, are you? Is that what you're referring to?
That's right. There's been commentary that might be an option the government might look at.
Yeah.
And I'm just intrigued to see what the RBA's view would be on, what impact that would have on your outlooks, and what would your general advice be on imposing tariffs like that in the Australian context?
Generally, I think we feel that tariffs are not a good policy instrument for Australia. We've done very well out of an open, fair trading system in the world economy, and we certainly, I think so far, certainly in response to the tariffs that have gone on overseas, the government has said, well, we're not going to retaliate, and a lot of other countries have done so too, because I think a lot of countries recognise that putting tariffs on things doesn't necessarily benefit the country.
And just to add, in the context of our inflation forecasts and respect to any government policy, as I said earlier, we would only be looking at things that have actually been legislated or announced as part of the budget process that we would anticipate would be legislated very quickly, which is why we've not done the work that you've outlined there.
Thank you. Do you think there is a risk that overly ambitious emission targets will risk increased energy costs and reduce Australia's economic growth?
Well, this is really not my wheelhouse. I'm not a climate economist, and I certainly have done no work in this area, and we haven't done any work in this area. It's not our... The bottom line is that we do some work looking at what impacts might be on the economy of physical risks and transition risks. We do it with respect to financial stability. We do it with respect to the economy. But I personally don't have any views on what particular emission target reductions would be appropriate. That's not my wheelhouse.
I'm going to ask about Martin Place. As someone going through some renovations myself, I can appreciate the frustration. We've had media reports suggesting that stage one has gone from a $260 million price tag to $1.2 billion. How confident are you that the final price tag will be $1.2 billion?
Well, let me just say that renovation is not what it is anymore, and I really would rather not be in this position. I'm not a developer, and what we are now faced with is a development. How confident am I at the ultimate cost? I'd have to say not 100% confident, but that's part of the reason why under the new governance board now we've got some very some targeted stage gates at which we're going to be looking at the project along and how the costs are lining up. The very first piece, though, is that we have to remove the asbestos. We built a building, it seems, that has had 4 to 5 times more asbestos than any other building of similar time, and we have to remove the asbestos. So that'll be the first bit, and from then we can start to look at where the cost might be. But my confidence, I'd have to say low.
Okay. Any confidence yet on the costs for stage 2A and 2B?
Not on 2A and 2B. We haven't even started. We haven't even really started to look at those in detail yet.
Okay. You mentioned the governance board. You mentioned earlier in your remarks about the new reforms that have come in and the fact that you're now going to be publishing anonymous counts on the vote or on decisions. What do you feel that risks creating a visible division at the RBA and complicating policy and creating unneeded volatility in the markets?
No, I don't think so. I think that once this system settles down, it was a great deal of excitement the first time we did it, particularly because it was a 6-3 vote. But I think as things settle down, it will settle down and people won't be as excited about it. And so far, I would have to say I don't think it is causing any issues on the board in terms of people being concerned about having a proper debate, knowing that there will be a publication of the unattributed vote. So it hasn't had that impact so far, but we'll have to see. It was a key recommendation of the review. We have implemented it, and we'll work with it.
Okay. I just want to go back to productivity. I think I'm going all right for time. You attended the Treasurer's Productivity Roundtable in August and even presented at it. Earlier that month, the RBA had, and you've mentioned already today, you've lowered expectations for productivity growth. Did you come away from that roundtable with any confidence that there are serious practical solutions on the table to boost productivity growth?
So I should probably just clarify, I didn't actually go to the whole roundtable. I went to the first morning, I heard the Prime Minister and the Treasurer speak, and I gave some remarks which was sort of a scene setter from where we were, but I did not stay for anything else. So I did not hear the conversation. Having said that, what I've heard reported is that there was some, I guess, agreement that there were some things that could be focused on, including the red tape issue, and certainly the Treasurer has written to me as the Chair of the Council of Financial Regulators, looking for what we regulators can do to be reducing red tape. So I think there are possibly some good ideas out there, but and the construction sector is one that I think people highlighted. And I should say that we're not the only country that has a problem with productivity in construction. A lot of other countries have similar issues as well. So I think there are possibly some good ideas out there, but I personally wasn't in the round table itself.
Okay. Last week's labour force data found that 5,400 jobs were lost from the economy. Was that out of line with RBA's expectations? And what will these new figures mean for RBA's future expectations?
So, again, like with monthly numbers for inflation, I would caution against looking too closely at monthly ups and downs in employment numbers. They can be volatile. Employment growth has certainly slowed, but the unemployment rate itself is still at 4.2%. So for us, I think we would think broadly that the labour market outcomes are pretty much in line with where we thought they would be in terms of the forecasts. And if you look at some of the forward-looking indicators, certainly things like vacancies, what we are hearing from our liaison program, there are still pockets of the economy where the labour market looks a little bit tight. So we can't see with some of these forward-looking indicators that there's going to be a sharp deterioration in the labour market. So at the moment, we still think it's close to full employment, maybe marginally on the tight side, but we're watching that closely. So that's sort of what we'll be focusing on in the next few months.
Just to add briefly to that, we were anticipating the pace of employment growth to slow through this year to 1.6% for the December quarter. That's about where the number has slowed down to now. So that slower pace of employment growth partly reflects slower pace of population growth and partly reflects some of the transition that we were talking about earlier on. So in that context, just to further what the Governor has said, we're not innately surprised by a slower pace of employment growth, and it is very choppy month to month.
Thank you.
Thank you very much. Well done. Member for Moreton, Julianne Campbell.
Thank you, Chair. Governor, I wanted to go back to RBA reforms and the review. And the new board structure has been in place for just over 6 months now. And really, I'm keen on understanding how you think it's operating on a practical basis and what improvements the new structure has given to the bank's monetary policy decisions and certainly its governance overall.
So I think there's been a few things, and some of these changes have been in place prior to the Monetary Policy Board starting. So we did them when the Reserve Bank Board was still meeting as the Reserve Bank Board. I think there's been a few things. I think we have we're structuring the papers and the discussion, I think, much more around the strategy for monetary policy. So, yes, we're interested in a decision at a particular meeting, but trying to take the discussion, I think, more towards how does that fit into the context of the strategy. So I think we've done a lot of work on that. We've done a lot of work, and some of it's found its way into statements on monetary policy, on making much more explicit what are our judgments, what are the key judgments we are making in our forecast, what are the key risks that we're identifying, what might we be wrong and where not. We've done a lot more work in the scenario space, thinking about different scenarios. So these are all things I think that were recommended by the review. And I think that's working pretty well. I think the board members are all very engaged. The Monetary Policy Board, there's only 2 new members effectively on it, or 3 now if you count the new Secretary of the Treasury. So quite a few of them are carrying over from the Reserve Bank Board. But I think there has been a sort of a change in the way we've tried to steer the discussion. So I think that's been very helpful. The other thing that's been helpful since the establishment of the Governance Board is that some of the things that the Reserve Bank Board were having to deal with now, we can take off their agenda. That goes to the Governance Board, so that's more time to talk about monetary policy and financial stability issues, which are the key part of the Monetary Policy Board.
And in your earlier statement, or your opening statement, I should say, you talked a bit about transparency and improvements in communications. I was wondering if you could let us know what has been the response to that from the public?
Well, I'm probably not the best person to ask about that.
I heard you getting emails from the public.
Well, that was always the case. We're always getting emails from the public. Look, I'd like to think that the press conferences have been very helpful. In the press conferences, I am trying to speak to the Australian people. I am not speaking to analysts and traders, and although they listen, I am trying very directly to speak in a language, hopefully, that people understand. So the feedback I sort of get is that seems to be working. But I think there's a difference between are people understanding what we're talking about and do they agree with what we're talking about, you know. So there's reasonable people are going to differ. I think that's fair enough to say, and so my task is to try and explain our position as clearly as I can, but I accept that not everyone will necessarily agree with that.
No, I understand. Can you talk a little bit about the internal changes within the RBA as part of the review, and specifically how the progress on those internal matters is going?
So there's been a number of internal changes. There's been some structural changes, and then there's a big piece on cultural change. On the structure, we've established a new area called Monetary Policy Strategy. We have our financial system group, a financial markets group and our economic group. And the strategy team is supposed to try and draw all the threads of this together. So I think we've made a lot of progress in working across areas now and bringing together the various strands, because they're not separate. And so I think, I don't think we were bad at that, but I think, you know, we've got better at drawing those various strands together. We've made some changes we're working on changes to our modelling capacity and that sort of thing. So we're trying to up our resources into modelling, scenario analysis, as I mentioned, our use of microdata. So there's a lot of work going on, and that's an ongoing piece of work. And then there's some other things that the review asked us to do in terms of a framework for unconventional monetary policy, which we're working on as well. So there's those various bits of work. The bigger, sort of more nebulous piece, I think, is on culture. And one of the things that the review asked us to do was to try and have a much more active and diverse conversation about policy and about options and those sorts of things. So that's a work in progress. What that involves is not only making sure that people feel comfortable speaking up and holding a different opinion, but that the leaders are actually listening. And so there's cultural changes from both directions. It's basically leaders being actively curious and listening to alternative opinions, and others being willing to express alternative opinions. And I think we're making some progress there, but you never quite finish that job. I think you've just got to keep working on it. So they're probably some of the key internal changes.
You talked about increasing the modelling capacity. Are we talking about expanding the capacity of what you're currently doing, or looking at different factors?
You want to speak to that, Sarah?
So it's a bit of both. So we've built and developed a number of models historically over a number of years. We're looking at expanding them, and it's a constant job because the economy is constantly evolving. So you can't take a model and set and forget. You have to constantly revisit it. So that's one stream of work. And then another stream of work is building our capacity and our analytical capabilities in new areas that we've not tackled and looked at before. We are looking at and thinking about, for example, the climate transition, as we talked about earlier. That's a new capability for us. We're looking at and thinking more generally about supply chain disruptions and supply shocks through the economy and what they mean. And we're also developing new techniques and ways of thinking about those more individual micro data that you mentioned earlier on. So we are one of the ABS's most heavy users of their data lab, which is where they house that data, and we use that data in our analytics. But all of those things, we're very lucky that we've now got some truly excellent people in the building doing excellent work in those areas.
Thank you. And Governor, I wanted to change tack very quickly for the last couple. Given the lags we often see in monetary policy that you've spoken about in the past, when do you see the full impact of interest rate cuts really sort of washing through the entirety of the system?
Well, I think we typically think of the lags as sort of full effect of 12 to 18 months, but I think it's probably fair to say that the most recent reductions in interest rates, we are seeing early signs that that is having an impact, and the obvious place we're seeing that is in the housing market, housing credit that Dr. Kent referred to. So in order for it to take its full effect, we typically think of, as I said, 12 to 18 months, but that doesn't mean that you don't start to see some signals early on.
And so in terms of those earlier signals, how do you think that households have responded to falling interest rates so far?
Well, I think what we are seeing is households' disposable income is rising. So it's rising for the reasons that Sarah mentioned earlier, which is that wages are increasing more quickly than inflation, but their interest that some households are paying, those with mortgages, that's declining too, so that's increasing their disposable income. And I think as people sort of get confident that inflation is coming down and that their wages are continuing to rise and that they think interest rates are on a downward path, that increases their confidence. So those are the sorts of things I think that we're starting to see partly in the consumption numbers, which is what our models would sort of suggest would happen.
Cool. Thanks, Ed.
Terrific, thanks. Member for Deakin, Matt Gregg.
Thank you very much, Chair. The numbers you were talking about domestically look quite good. So are the current forecasts on wages and on inflation consistent with the target rate or the target band that you're working on?
Well, interestingly, the forecast we've got at the moment, conditioned on a continued slight further easing in policy, does look pretty good. It looks like we'll have inflation back at target, and we'll have unemployment not rising by very much, and we'll be close to full employment. Having said that, I always make the point that the further out you go with these forecasts, you don't know, and we're probably not going to be right. In what direction, we don't know. But certainly the way the board has been approaching this is to look at the forecasts, adjust policy as we become a bit more certain that we are starting to meet those forecasts, but be alert to the fact that we might be wrong in either direction. And that's what I mean when I sort of talk about the need to respond as the data, not just the backward-looking data, but the forward-looking data move on. So I say at the moment we're in a pretty good position, but they're forecasts.
So where does that data tell you we sit on our fight against inflation? Not quite mission accomplished, but are we getting closer?
I'd say we're getting closer. We are, as I said, we're back in the band, 2.7% on underlying. Headline's going to go a bit like this. But I think now, if you asked me a year ago, how confident am I? I'm more confident than I was then. But we just have to wait and see. And again, the point here is to try and keep it sustainably in the band. We don't want it sort of popping out either direction if we can avoid it, you know. So I think 7.8 to 2.7, that's a lot of progress.
So I suppose one of the things that would keep you up at night, like us, would be global events that are beyond our control. Going to some of the, I guess, some of that uncertainty, the Chinese economy in particular obviously has had some developments that are a little bit worrisome. Could you talk to how do you think that's going and how you think it might impact our economy?
Yeah. So we've been, I'd say up until now, we've probably been reasonably optimistic in the sense that we felt that the Chinese authorities would do what was sort of necessary to meet the growth target of around about 5%. And so far they have been meeting that. I'd have to say, though, recent data have not been particularly encouraging, and particularly the fixed asset investment data that were released fairly recently were not great. So we, I think, having gone to being reasonably confident, maybe we're watching that a little more closely now. I guess that's all I can say. I think probably recent data have suggested that, well, maybe they're not doing quite as well as it may be, that the tariffs are starting to hit them a little bit. And of course, there's no deal there yet either. So there's some uncertainty associated with that. I think November is when the latest moratorium runs to, but this whole unpredictability of tariffs, I think, is part of the problem here. So until that all settles down and we've got some certainty about how China's going to be treated, I think it's quite difficult to sort of say, well, everything's going to be fine. So I think there's still worries there.
Just to add, we'll be paying very close attention to what the authorities in China actually do, and as the Governor said, it's very new data, and we have seen them respond in the past when they've seen weakness in their economy, so that's going to be a key factor over the next couple of months as well, what the authorities actually do in response to what's happening.
So any indication from the authorities so far not going down a stimulatory route or anything?
No, but it's very, very new data, so we wouldn't necessarily expect them to have said something at this stage.
I mean, their sort of response up until now has been that things seem to be going okay and that they'll be ready to respond if they need to. But, you know, they are addressing interesting issues over there. They've got some overcapacity issues that they're trying to grapple with. They've got the tariffs uncertainty and the issues that they're trying to grapple with. We know, though, that their exports are holding up because their exports to the US have declined, but their exports are going elsewhere. So there is trade is shifting. So it's just very difficult to read.
Dynamic space.
Yes.
Thank you. On the modelling of scenarios, I know one of the RBA review recommendations spoke about doing modelling with Treasury. Obviously, we've got different roles in fiscal policy and monetary policy, but kind of collaborating on some of those projects just to make sure we're on the same page and we always understand the challenges in front of us. Has that work with Treasury begun?
So I don't know if you're referring to the recommendation that we should work on the relationship between, or the interactions between fiscal and monetary policy. First thing to say up front is actually our teams work very closely with Treasury. They're in constant contact. Our forecasts aren't necessarily the same, but if they differ in slight ways, we understand why. They might have a slightly different view than us, but we work very closely with them. On the fiscal monetary interactions, we just recently held a conference jointly with Treasury, which was our first sort of foray into this space of monetary and fiscal interactions, how they work together. The challenge here is that they are independent policies. We set monetary policy and we take fiscal policy as given. As I've said in a number of other times, fiscal policy is, quite rightly, the responsibility of government, and it has many, many different aims and services it's got to provide and so on. So it's quite proper that they are separate, but we do need to understand the interactions. The conference was the first step, and we're now basically working with Treasury to map out where to next in terms of making sure that we're in sort of, not lockstep, but we understand where we're at. And look, we're building on a very good foundation there.
Excellent, thank you. The next question I had, going back to what we were talking about, confidence before, and business investment as well. We were saying that access to credit isn't necessarily the key limiting factor. Is it something more to do with confidence, and would the lowering of inflation hopefully help feed a bit more business investment, particularly in those things that increase productivity? Is there a reluctance to kind of spend within businesses on investments within the business? What do we think is driving that?
Do you want to say a few words on that, Chris? Or
Sarah, I could answer it. I mean, if you look at business surveys, conditions are round average. It's quite a contrast to the household sector. And I think the point I was trying to make is I think businesses will look not to the cost of funding to drive their business investments, particularly external funding, which isn't a large part of their needs. They'll look to other sources of demand, which is a pickup in the household sector, dwelling investment and consumption.
Yeah.
So, Councillor, did you just say they will not look at the cost of funding as a decision?
I don't think it will be
point?
a key driving force. So the fact that we've reduced interest rates 3 times won't directly, it will reduce the cost of their funding, but that by itself is not enough. Funding is not a constraint for business sector as a whole, noting what I said about small businesses. They're looking to other sources of demand before they want to ramp up investment.
Just to add to that, we actually ran a survey recently where we were asking businesses about effectively the product, what they saw in terms of productivity driver and their investment trends. And it was quite striking that when we asked them if access to finance was a barrier, and again noting SMEs and startups clearly are more challenged in this space than others, but as an overall aggregate, it wasn't flagged as a constraint by the vast majority of businesses we spoke to, which are in our liaison program, and that's a pretty broad sweep of the whole country. So it is interesting that it doesn't look like as much of a constraint as you might otherwise think.
Thank you. That's all from me.
Okay.
Thank you very much. So do you publish that before I go to
Yes, another shout out for the August SNP. It's in the messages from liaison box, which you can find on our website.
Okay, thank you. Now, the member for Brisbane has been put in the worst possible position of being the last questioner before we go back round for others, so thank you for your patience. But to Majona Jarrett, member for Brisbane, over to you for 10 minutes.
Thank you, Chair. I want to actually go back to surcharging, if that's okay. And obviously my questions are in the context of, I understand that you're in the middle of your review at the moment, but however, I understand that a number of small businesses, or almost all small businesses in Australia, are on blended pricing plans. Now, back in 2015, the UK introduced interchange caps, and I'm going to read the figures here because I don't know them off the top of my head. They cut costs for payment service providers from an average of 1.3 to 0.3 for credit and 0.8 to 0.2 for debit. And then if you look at the impact of that now, we currently see that capped interchange rates 10 years later are at 0.3, but the small business merchant rates haven't changed at all. And what concerns me is we don't want to necessarily see that impact here in Australia. So are you confident that that won't happen, or are there steps we can take or that can be taken to ensure the savings do flow on to small business, given what we've just discussed?
It's a very good question, and it's something that's come out of the consultation process that I think it's fair to say, and I'll pass to Brad in a minute, but it's fair to say that practically everyone has recognised that the cost to small business of accepting cards is higher than it should be, and that big strategic merchants get very, very good rates, and it's paid for by the small merchants. Will interchange reductions get passed on? I think we'd sort of come to the conclusion in the consultation document that if you had enough transparency and around this, that would help small merchants to compare figures and then move. But there are frictions, so I think that's a question that's been raised in the consultation about whether or not it will be passed on. So I don't know, Brad, if you've got anything to add on that. So it's a very fair question.
Yeah, one of the things that we're hoping is, or expecting to see, is that now merchants are going to have a very direct incentive to shop around for the best deals, and we want to empower that by shining a light into some of the dark corners that have long persisted in the payment system. That's around, in particular, transparency on interchange and scheme fees, which the overwhelming feedback we've got from this review is, for most businesses, the fee schedules are just impenetrable. They don't even know what they're really being charged. So we want to get more sunlight into this system, and we think that will help empower merchants to make informed decisions. However, in the event that that alone is not enough, and we're alert to that, we do have sort of like an escalation ladder, if you like, different measures we could consider. Voluntary undertakings, setting new standards, and there's potentially the most extreme option would be regulating the margins of acquirers. So we want to let the market work, and we want to get as much sunlight and transparency, getting those fee schedules out in the public domain. But if that is not enough, we've got levers and we won't hesitate to pull them.
When will we know if and when they're not enough?
Well, I think we're in the consultation process at the moment, and we're getting, some people are directly providing us feedback on alternative ways to bring fees down for small merchants, that we're having an active conversation with people about that. We'll have to make a judgment about whether or not we think we go with the market solution first, or whether we really don't think that's going to work. But usually we would like to try the market solution first, and I think it would be reasonably obvious within 6 months to a year whether or not that's working or not.
Okay. And is there any plan to include scheme and acquirer rates in all of this review? Because at the moment, unless I'm missing something, most of the focus is on interchange rates, right?
Well, the focus is on interchange because it's a big component of the acquirer fee.
Right, okay.
So interchange is paid by the acquirer, so therefore it goes into their base costs, and then they add their margins on top of that.
Yep.
So that's really what we're talking about here. How much competitive pressure is that margin actually under? And I think what's been demonstrated with the surcharging regime is that it's been under no pressure at all, because the merchants just pass it on in a surcharge.
Yeah, yeah. And is it, or have you given consideration to different approaches for debit versus credit?
On surcharging?
Yes.
We did, and
where did that land?
Our consultation and looking at the costs and benefits of that, just saying you couldn't surcharge for credit but you could surcharge for other things was probably going to end up being much more costly in terms of systems changes and complication than just saying no surcharging at all. But the quid pro quo of saying no surcharging was to try and get small merchants' fees down. So we did actively consider that issue, and we concluded with some evidence that it was not really, didn't line up in terms of cost benefit. It was much simpler.
And a small business on board with that?
Small business would like, I think, well, some elements of small business would like the ability to surcharge, to retain the ability to surcharge, and that's to be expected. But our evidence is that around about only 10% of small businesses surcharge. We all think it's much more than that because it's all the ones that are in our face all the time.
Yeah.
but actually it's not a big share of them, and most of them don't. So they will benefit if we can get their merchant service fees down.
Okay. Look forward to the outcome. I do want to change tack, though, to an area that's very close to my heart. I read your speech to the Shan Memorial Lecture in September in relation to AI and technology, and looking at what that can mean both in terms of how you read the economy, but then also how you can use technology and AI to strengthen the way you operate. So if I jump first to the looking outwards piece of it, how will you monitor like the technological change in the economy and the payment systems? Like, how are you going to be going about this? I know that's a really big question in a really short period of time, but
it's a couple of quick reactions. In terms of the payment system, actually, I think we're pretty ingrained in this. We have lots of contacts where we're watching all this and have been closely for years. So I'm not so. The issue more about what it might mean for example, businesses and the economy more broadly. Our liaison program is going to play a very important role here, because that's where we get out and we actually talk to businesses about what are you doing, what are you seeing the impact on your businesses. And there's ours, but I suspect there's going to be lots of other surveys and people going out there asking similar questions of businesses. So I think that's going to be a very big foundation for us. That's how we're going to get our information. In fact, we've already started asking them about it.
Right, okay. Again, something I'll watch carefully. The other piece is too, you also talked about central bank digital currency and the possible future wholesale tokenised asset market, data analytics, etc. So obviously looking internally at how you can use technology better. Could you talk a little bit more about the progress towards the central bank digital currency and where that's at? And then, again, it's a bit of a broad question. Where do you think the best investments can be made for you at the bank to best use technology to support, you and your duties towards the Australian people?
Okay.
Sorry, big questions.
Very briefly, and then I'll ask Brad to be very brief. On CBDC, we don't actually see a burning need for what we'd call a retail CBDC.
Okay.
Our focus is much more on what a wholesale CBDC, so a central bank digital currency, might be able to do for wholesale markets, in particular tokenised markets, which is what Project Acacia is about. You want to say a very quick few words on that?
So the use cases, for instance, fixed income, private markets, trade receivables, carbon credits, they're the sorts of use cases that participants are trialling in the project. We will conclude the transaction part of that pilot by Christmas time, and we'll have a report out in the first part of next year on our findings and where we take things going forward.
You said first half of next year, sorry? Yeah, thank you.
So that's an actual experiment. On our own internal use, I mean, we're still working on that. I did give some examples in the Shan speech about the way where we've got people who are very interested in this, and they're building little techniques for us to use to harness the liaison data more quickly. The analytical notes thing is another very important one. So we'll continue to look for ways to usefully utilise it to help us free up time of people. We'd normally be doing sort of detailed drudge work, free them up to actually look at the outputs and think. That's the idea.
And that information from liaison is already being fed into our forecast process. It's already an input, the same way data from the ABS would be an input. So we're already on that journey.
Right, and I'm assuming in your annual report going forward, we'll see what progress against various milestones that you've set yourselves, or is it a bit more general than that at this point in time?
Yeah, you will. The governance board now is responsible for the annual report, so they will be keeping track. One of the things they're interested in is what we're doing with AI. So not just in this area, but in many other areas, you'll start to see that.
I'm sure. Do I have time for one more, Chair?
Well, you were the last one, so we should cut you some slack.
I just wanted to build on one of Matt's questions in terms of productivity. You had mentioned earlier that and this goes to business and business productivity, that we haven't seen here what we've seen overseas. That was a comment that you'd made earlier in terms of business and productivity. I'm assuming you mean improvement. If so, what are the drivers?
So I was referring, Sarah talked a little bit of this as well. I was referring to the United States, where you have seen productivity continue to rise in the United States, and it's a standout relative to everyone else. My comment was reflecting some work that we have done on business dynamism in Australia and how close are Australian businesses to the frontier, if you like? Are they being innovative? And I think the evidence from the work that was done was that basically even our most innovative firms really aren't out there as well.
We dip back a little, and the other key finding from that work was the diffusion of new technologies and new processes across the economy had slowed down. That's actually quite important for a country like Australia because we're small, so we're not going to cut the productivity edge in lots of sectors. We just can't expect to do that. What we do have to do is take the cutting edge and get it across the economy as much as possible, and that process has slowed in recent decades.
Yeah.
And is that really what's driven the US productivity growth, that sort of approach, or is it even something different there?
It's a good question. They don't have an answer to that question. There's lots of possibilities. Certainly the investment in AI and related technologies is part of the story there, and that's very clear in their data. It probably doesn't explain all of it. It's still early days for them too. So it's a puzzle, to be honest with you. It's one of the big puzzles at the moment.
When I ask my counterparts about that, they say that they've just got more business dynamism in the United States. They've got birth and death of companies. The resources move to where they need to move to. So, even if their productivity has slowed, it's still rising, and that's their explanation.
Yeah, the other thing that's unique to the US, though, is they have a fantastic way of commercialising university-based investment. We haven't quite cracked that model, and no one really has any other country other than the US.
Okay. Thank you.
So what I'm proposing is, thank you very much for that, two quick questions from myself and the chair, and then what I'm going to do is go this way. Everyone's got this is our equivalent of lightning round. You've got a chance to have a follow-up question, and then if we have more time, we'll be able to reopen it. So two quick questions. My understanding on the reforms, and just correct me if I'm wrong, Governor, to the structure of the RBA, was that with the members of the Monetary Board, they'd all have an opportunity for public-facing to be able to speak. Do you see that still occurring? Will that be the case? Question one. Question two, can I just take the productivity issue, judging by your responses at your August press conference, you just love talking about productivity non-stop. But can I take it from a lateral point of view? Some of the best performing nations on productivity probably are a lot more economically complex. We are not doing so well on economic complexity. We wedge between, I think, Senegal and Yemen, an incredible place to be. Do you see greater complexity? We make a lot of great, like a lot of national income of some major players. But do you think the longer term, is there an interplay between economic complexity and national productivity? So that's a second, much longer, so-called quick question.
Okay. On the second one first, I don't think I've ever really thought about that as such. I've certainly...
Do I get a prize?
In the context of complexity, certainly, as as economies become more advanced, what the sorts of things they produce changes, and the sorts of things they consume changes, and that might well have implications for productivity. And if you think about that as complexity, then yes, it might well. I might let Sarah make a comment on that in a minute. But on the Monetary Policy Board public appearances, yes, we do have something on the website now which sets out how that might work, and basically there's a number of ways that they could make public appearances. It mightn't necessarily be speeches. It might be they might attend a town hall and listen to perspectives. It might be that they might be on a panel or something like that. So there's sort of the way we've worked with the board is to get a bit of a menu of things that they can do. and support from staff as well in doing that. And so, yes, that is actively live, and I think a couple of the board members are already thinking about how they're going to put that into practice. Did you have anything to add on complexity and productivity?
Super quickly, those measures are definitely, at least partly, you could say a large part, reflective of economic fundamentals of countries. So in particular for Australia, we're obviously blessed to have a vast abundance of natural resources. Countries in that position tend to be less complex because we take advantage of that. So we obviously have our iron ore exports, natural gas and so on, and that then dominates our export picture, which is a big part of that complexity piece. The other part of it for Australia that's sort of a fundamental is geography. We're a long way away from most other parts of the world, and so the kind of trade and the trade flows that you would get in, say, Europe, where goods and services are crossing borders all the time, we don't necessarily get the same dynamic here because we're just so far away.
But to the first one, sorry to interrupt, it influences productivity. So if mining is in an investment phase,
it does, exactly.
That influences national productivity figures. And then when they scale back, it has a similar influence, right?
Yes, which is what we were discussing earlier on. So I think, I suppose my top line summary is you have to be a little bit careful just to take the bold statistic, because I think there's a lot in there that we can understand and that we wouldn't necessarily want to change. I'm not sure we would think we shouldn't take advantage of our natural resources. Having said that, to my earlier point, that diffusion of new ideas and approaches and productivity across the economy, across all sectors, is vital, and that will surface new areas where we have a comparative advantage, where we can take advantage of that and lift our living standards. That's really important too. So it's a bit more complicated than the top line figure, but yeah.
Thank you.
Thank you very much. And just look, returning to energy, and don't want to get you to comment on climate targets, get you not climate scientists, or climate economists, economists, I'm sorry. But yeah, given it's so important to the economy, 60% of a lot of manufactured goods, the cost of energy, it's increasingly in services now with AI and everything. I noticed Mike Henry, and we were talking about the US before, very good at productivity, it's not lost on me. Mike Henry last week said, Australia's economy, the cost of energy is 2 to 3 times that of comparable economies. He sees flight of capital. One of Australia's biggest companies, the CEO, sees capital going offshore. So if you're not modelling it, do you plan on modelling it, or are you concerned by comments like that? The CEO of one of our largest companies, was one of the largest companies in the world, saying they see that as uncompetitive and capital's going to go elsewhere.
Yeah, well, that's obviously of interest to us, and I think we came back to opportunities. I mean, the number of people have said it. I mean, we do have opportunities in green energy. The question is the transition and how you get yourself there, I think having certainty about the policies, the government policies, is really important there. I think, we've sort of, at least now we've got some certainty. You can argue about, whether or not you think the targets are right or not, but I think there's a great deal of store to be placed in certainty about government policy, and that allows people to think about investment in the transition and in the ultimate outcome that we get. So I think that's actually really important that you do have that certainty of policy, because that will help. But obviously, if we're hearing in the traps and hearing from our liaison program that businesses are saying, this is never going to work here, then that's of interest. Yeah.
And just to double back on that, good, it's of interest, but when we've got leading companies saying 2 to 3 times capital flowing, is this something you think the Reserve Bank should look more deeply at, given that, I think I remember you said in September 23 it added a percentage point alone, energy to inflation. So given the effect it has on inflation, your primary job, forget the targets themselves, whether they're appropriate or not, it just concerns me greatly as a policymaker, hearing business say, wow, this is that uncompetitive, given its effects on inflation and the rest of the economy. Is this something we should be having a sharper view on the effects the policies that affect it?
I think Sarah wants to say something, but let me just make it clear here that saying that energy is more expensive in a level sense is different than saying energy inflation is much higher than other countries. So what we've, so...
Assumably it would have had to be, if we're 2 to 3 times comparable economies, assumably we were in the cheapest 20 years ago.
I'm not sure of the numbers, but whether that's true or not, I don't know. But
yeah. So to be clear, we don't ignore energy. It is an important part of inflation, as you've pointed out, but we're not experts either. So we make very heavy use of work that's done by AMO and others in this area who are the experts. And that's very influential in terms of our forecast for the very sort of near-term outlook, the 1 to 2 years. So we're making use of that and talking to colleagues in Treasury and elsewhere on those types of issues. And in terms of business investment and what might be driving investment, and you talk to capital flows, but we're really, from a monetary policy perspective, concerned with actual economic activity. We're also tracking that very closely as well. If we saw that was happening and that was most importantly having an impact on the level of business investment in particular, then that's what you would see coming through the numbers, and we would obviously be talking about. So we're not looking at it or monitoring it, but we're not also building specific expertise to understand in lots of detail the energy market itself and the energy transition. We do need to understand it, and so we do invest in that to understand it, but we're not playing the same role as AMO, for example, so it wouldn't be appropriate for us to have a similar kind of expertise in-house.
Well, between the Deputy Chair and I, we've introduced the slowest moving lightning ever. Henry and then Madonna, one question, if you can.
Thank you, Chair. Well, just, we're obviously heading into that period of the year now where you're looking towards the final decisions of the year and looking forward to 2026. I'm just interested to get sort of after everything you've mentioned today, what are the biggest risks for you when you're looking at the assumptions, when you're looking at, what the Monetary Board has to look at over the next few weeks? What are the biggest risks in terms of what your existing assumptions are and what you're looking at as you head into 2026? Where do you see the biggest risks, and maybe just identify that and then go from there.
Well, I think the international environment obviously has still got a lot of uncertainty and risk, and they go both ways. Mm-hmm. So that's sort of the challenge there. There's the possibility that if it all explodes and major trading partners' growth turns down, then that's bad for us. If it all settles down in a quite not ideal way, but it all settles down, then things might be fine. So I think the second risk probably for us is that we're thinking about consumption. We're expecting it to pick up. We've been expecting it to pick up. It's been a bit slower than we thought it would, but we think now we're seeing that. So if for some reason it doesn't continue to pick up and we don't get the handover from the public to the private sector, that might not be good for the labour market, and we'll find ourselves in a position where we're perhaps undershooting, we're lower on inflation and worse on employment than we would like to be. So they're sort of a couple of the risks that I think we're focusing on, but it's a challenging environment, I'd have to say at the moment.
Thank you, Madonna.
I'm going to climate risk, actually, on the theme of risk. The National Climate Risk Assessment highlighted the escalating impacts of physical and economic... highlighted the escalating physical and economic risks to Australia. Have you seen a change in the risk profile over the last few years, and can you predict where that climate risk might go in terms of how you think about the economy, and do you see an urgency to do more to reduce that risk?
Another big question.
Sorry.
We look at it from a couple of perspectives. One is the potential impact on the economy and the supply side of the economy and what that might mean for inflation. So we have people working on that, and as Sarah alluded to, we're sort of beefing up our modelling on this side. So second perspective, we look at it from a financial stability perspective, what some of these changes might mean for the financial system. Will there be financial risks that arise in the books of financial institutions? We think at the moment that those risks are not dramatic, but we're keeping an eye on them, and we work with APRA, potential regulator, on that. But there's the banks themselves, obviously. There's the insurance companies as well. So these are the sorts of things that we're also thinking about in terms of climate.
Thank you. Matt?
There's been a bit of talk about the US economy today. I was just wondering what the bank makes of that kind of rapid softening of the US's labour market and what implications that might have.
Just very briefly, I think we've got to be a little bit careful here because the US has also seen population growth because of the immigration approach drop off quite dramatically. So the Fed always makes the point that the unemployment rate actually hasn't increased much, even though growth in employment itself has softened quite a lot. So I think it remains to be seen, but certainly it's not just about lack of employment growth, it's also about the supply of labour is not increasing nearly as quickly as it was. So that's at least part of the story, I think.
Labour?
You briefly touched on regulation earlier in the conversation, and certainly there's certainly out of the productivity roundtable that sort of positive tension of how do you back both growth and protection in terms of how regulators see their roles. I'd be interested in understanding how does the RBA think about that balance, and particularly in relation to, say, for instance, ASIC's today's report in relation to private credit, for example, which is an example of that sort of tension between growth and sort of prudential regulation. How do you think about that balance? How do we get that balance right for growth?
Well,
big questions, I know.
It's difficult. I think where everyone's grappling with this balance, and at the moment, post GFC, everyone's swung to much more regulation.
Yeah.
What you've observed since then, as you do when you regulate, is you observe business, if you like, credit start to move into the unregulated parts of the economy, and now the regulators are worrying about that. So where do you draw the line? I think the pendulum swings over time, and I think there's a tendency for it to sort of swing too far one way, then possibly too far the other. In Australia, I think we've tried to get the balance right, but there's an active debate about whether or not we have got regulation too risk averse and whether or not some loosening might be appropriate. The challenge with that is that we in Australia typically don't have any tolerance for a failure of a financial institution. So if you don't want to tolerate the failure of a financial institution, then you've got to sort of expect that maybe the regulation has to sit on the slightly tighter side. So it depends a little bit on the trade-offs that people are willing to accept, frankly.
Thank you. Julian?
On surcharging, you talked about one of the key objectives for the RBA to allow smaller merchants to be able to shop around. Obviously, smaller merchants, for the most part, are small business owners and they have very busy lives, very busy plates. How is it going to practically be able to do that, and what are the improvements going to mean for small businesses and consumers in that context?
Do you want to speak to that briefly? It comes down, I think, to helping them navigate what is a really complex and non-transparent fees. That's really what it comes down to. We've got to do better. Small businesses don't want to be bothered with understanding the complexity of all the fees they have to pay. They want something simple, and they want to be able to quickly change acquirers if they find someone who does something cheaper for them. So what we're trying to do in this context is balance this whole complex situation of trying to say, well, you can't surcharge, we're going to lower these fees. How do we make it obvious to you what you are paying and what you are paying for and what your other options are? That's what we're trying to do.
Sally?
Just wanted to quickly ask about real wages growth. Note that we have now gone from flatlining wages growth to one where it's starting to rise. What are the drivers? Obviously, inflation coming down has been very helpful, but what are the other drivers for that? And how do we make sure that real wages don't flatline again?
I think inflation is the main reason why, the decline in inflation is the main reason why real wages are now rising. So there was a period where wages were rising by about 4.5%, and inflation was rising by much more than that. Now wages are rising by about maybe 3.5%. I don't know, maybe I'm wrong there, but
a little bit better than that, about 3.5 to 4, depending on the metric. But the way you sustain real wages growth in the very long run, so to over decades and decades, is productivity. That's the only. When we look at it causally and you look at it on a chart, it's really clear, strong relationship. That is the source of real wages growth. It's the only way.
In the long run. I mean, in the short run, you can get divergence between productivity and real wages growth, but in the long run, they're very, very closely linked.
Okay, so we still have more time. So what I'm proposing is one opposition, one crossbench, and then if any of my government colleagues, if there's someone that has a burning question, by all means. So, Deputy Chair, you've nominated.
Oh, if that's okay, yeah. So I want to go back to energy. Given I think the total subsidies are almost $7 billion from the federal government, $6.8 billion. Given you've previously said it's added alone 1 percentage point to inflation, given they're coming off those subsidies, isn't that a massive risk in the inflation forecast? And, how are you getting comfort on that?
Well, it's not a risk in the inflation forecast because we know it's happening and therefore we can put it into the forecast. So it's not an unknown, if you like. It's back to the point I made earlier that...
But the effect of subsidies coming off is an unknown. Like, have you modelled exactly...
This is cakeism. You're having your cake.
Sorry.
Goodness, I will try and keep this short, but it is going into the weeds of our inflation forecast. So effectively the way we build up our electricity, the electricity component, the inflation forecast, is we take the sort of market price, which would be what everyone would pay, there were no subsidies, and then we add or detract subsidies from that. So what we've got, we know what the market price is, that's the DMO, and we can then have the subsidies pulling that down, and then as they're taken away, the actual price approaches that line, if you like. And so what we have in the forecast is headline inflation, which is where this shows up, is going to, we think, get to around about 3% at the end of this year, early next year, and that's when the full effect will come through. The subsidies will be all removed then, as legislated. And then after that, headline inflation will gradually track back down to underlying inflation, which already strips it out because it's a volatile component, and that's when it gets back to 2.6, 2.5% at the end of the forecast. So that's what we've got coming through the forecast, and the primary driver of that gap at the moment is the electricity subsidies and their unwind. So we have mechanically taken that into account and in our bottom-up forecasting process. What actually happens to inflation, of course, we don't know. It's a forecast. Anything could happen. We can see petrol price movements, any number of different things. But in terms of the impact of the subsidies unwinding, that we can actually be quite sure about because we know how they're calculated and what they're doing at the moment.
So this is a follow-up question to the question on regulation. I take your point. Australians won't stand for a collapse of a major financial institution, but there are the big four banks, and then there's the whole rest of the system. And I guess that's the question that gets to these question of trade-offs, right? That we have in terms of financial dynamism and regulation and financial sector productivity. And so I'm really interested in particular, say, for example, this ASIC report that has come out today in relation to private credit. That's not about financial institutions, that's about businesses. Like how do we, are we even thinking about the costs? How do we even get our head round what are the costs of this sort of trade-off for stability that we have gone for? How do we get our heads around it? How do we really assess the cost to the country and the economy of some of these choices so we can consider whether they are the right choices or not?
Well, I'm not sure we can model it as such. I think there's a lot of judgment involved here. Having said that, I think there has been a recognition. Certainly, APRA has been looking at ways to ease the burden of regulation on smaller financial institutions. In recognition that, the big banks are arguably too big to fail, smaller institutions, it's harder on them to meet regulatory burden, so maybe there's ways we can ease up on them. So that's a recognition in an implicit way that there are costs to doing this. I think on the private credit thing, I haven't read the report yet, I have to confess. It wasn't first thing on my list this morning, but I will go back and read it. Again, it depends a little bit on the cost is dependent, I think, on people's judgments about what we're willing to tolerate here. So people will say, well, look, private credit is good, the concept is good, it's filling a space that others don't have. On the other hand, might only take one or two people to get badly ripped off by this and lose money in some sense. So because the private credit's being raised from somewhere, and I think, at least if I read the papers this morning, part of the point was that where they're getting this private credit from, it's not 100% clear if people understand the risks they're running in providing the private credit. So it might only take one or two people to lose money, and all of a sudden government and regulators say, well, that's not acceptable. Or do we say, well, buyer beware? But that does have implications.
I think if I understand, again, I haven't read the report either, but my sense of the key element of it was providing information. So the risks you were taking as an investor in this space were well considered. And so it was about the private credit providers who are looking for investors, giving them accurate information about the risks they're taking. So if they do lose money, they do it with their eyes open. But I think that information provision is, the foundation of a very good financial system, including on pricing. That's how people shop around. That's what the essence of what we're talking about with surcharging. It's the essence about finding a good deal as a borrower or as a depositor in a financial institution, big or small.
Yeah, thank you.
I was just wondering, building on our earlier conversation about CBDC and the bank's reluctance to absorb new costs, is the introduction of the digitised tokens and things like that likely to reduce the costs of managing money on a wholesale level, which will hopefully assist the financial industry?
Well, that's possible, I suppose.
Yeah, I mean, that's absolutely one of the reasons that basically every major central bank in the world is looking at this space. So the benefit proposition for tokenisation is that reduces counterparty risk in the system. If you shrink that time between trading and the money exchanging, you shrink that potentially to zero, means you take credit risk out of the system. Potentially you also take cost out because you won't have your collateral tied up for 2 days waiting for settlement. There's going to be more informational efficiency because these tokens can literally be updated minute by minute, second by... You can be earning interest, for instance, on a tokenised money market fund, minute by minute, and potentially increasing or introducing liquidity into asset classes where there literally is no liquidity. So these are all the potential benefits. There are some challenges though, and we're making sure that as we do this analysis that we're very clear-eyed about what those challenges are and making sure that the opportunities stand up to closer scrutiny.
Thank you. Tremendous. Okay, well, we're about to wrap up. Just on that AI thing, I think it's important not to be utopian or dystopian about these things. The belief that AI will be the productivity boost. I was just going to commend Sandra Peter and Kai Riemer from the Sydney University Business School, late July in the Fin, talked about AI repeating the IT productivity paradox. Very much worth reading, not necessarily for the bank, but for people that are listening in. So that's my final observation. I want to thank you very much for appearing before the committee today. The committee secretariat will be in touch with you in relation to any matters arising out of today's hearing, and you'll be sent a copy of the transcript of your evidence, and you'll have an opportunity to request corrections to transcription errors. Again, I thank you all for making the time to be here today. To all the members, thank you very much for your cooperation and for the breadth of the questions. And with that, I declare that the public hearing is closed. Thank you very much.
Chair.
Thank you.